If we could find our seats, we'll get started. Senator Hicks, come on forward. Absolutely. Okay, I call the meeting to order. I'll note that we do have several of our members participating via Zoom because of weather and whatnot over the last day. So with that, Karen, go ahead, and I think you're the one taking roll, Karen, is that correct?
Yes, sir.
Karen, go ahead and take roll, please.
For the Select Committee on Capital Financing and Investments, October 30th. Senator Driscoll.
Here.
Senator Furphy.
Here.
Senator Guru.
Here.
Senator Hicks.
Here.
Senator Steinmetz.
Here.
Representative Harshman.
Here.
Representative Knapp.
He's somewhere online.
He raised his
I
hand.
raised his hand, yes.
Representative Larson.
Here.
Representative Storer.
Here.
Representative Overmueller.
Excused?
Thank you. Co-Chairman Nethercott.
Here.
Chairman Walters.
Here.
You have a quorum.
Sounds great. Just a little forecast for the day. We will be taking a long lunch as the Vice Chairman and I have an engagement over the lunch hour, so we'll be breaking at 12:30 and probably won't be back till close to 2:30. Just give everybody a heads up early in the day on that. Madam Vice Chair, do you have any comments, or are you ready to rock and roll? All right, with that, moving on to the next item, the approval of the minutes from our September 6, 2024 meeting. Are there any additions, corrections, or changes? With that, I have a motion from Representative Larson to adopt. Is there a second?
Second.
Second from Senator Hicks. All those in favor signify by saying aye. Aye. All those opposed, no.
Mr. Chairman,
Will stand as circulated. Senator Hicks.
if I may just recognize a couple of other members we have in the audience. We have Representative Pendergraft, and we have candidate Gary Crum from Laramie. And so I'd just like to recognize them this morning.
Welcome. Thank you for being here, Representative Pendergraft, and hopefully Senator Crum. Welcome and glad to have you here. Moving into our first item of the day, it's a performance comp review from Makita Investment Group as well as RVK. Do we know who's on line first, Karen? If
Mr.
not,
Chairman, per the agenda, we have Makita up first.
Perfect.
And so I will bring in their contingent.
so very good. We'll start with Makita and their review. And this, members, as we recall, comes from a legislative directive coming out of last session, wanting to make sure our performance compensation benchmarks are appropriately being audited and being set appropriately. And so that's how we came about this report, and we'll see what they have to say.
Mr. Chairman,
Representative Larson.
Is that all of them?
so as I recall, and just for maybe those who might be watching, Makita does much of the work for the WR, the retirement system, and RVK does a lot of work for the Treasurer's Office. And in this situation, we've got Makita that done the review for WRS, and RVK that done it for WRS, so they kind of switched positions to where they weren't reviewing the stuff that they, do I have that accurate?
You are correct. They did switch positions, so it's essentially not the student grading their own homework, if you will.
Thank you.
And Mr. Chairman, if I may,
Senator Hicks.
could you remind me exactly who employs each one of these Makita and RVK, whether those are directly employed by either WRS or state treasurers, or are they hired by the SLIB? I think that's important to understand who they're actually under contract with.
Yeah, we'll let them speak to who they're under contract with, but my understanding is Makita is under contract with WRS, and RVK is under contract as a consultant with the State Treasurer's Office. For this purpose, it was a direct appropriation from the legislature, and the legislature made the hire in this situation.
Thank you, Mr. Chairman.
For this singular report. With that, go ahead, our friends from Makita. We'll let you introduce yourselves, please, and identify who will be presenting and how you'll be presenting. So go ahead and identify yourselves and proceed.
Great. Good morning. Thank you so much, Chair Walters and members of the committee. If I could just really quickly ask for one technical update. I believe that Susan Brumbaugh still needs the panelist invite perhaps again to join us all. She is from Makita as well. I think she may have missed it. We have
We
a,
will get that sent to her right away.
I see her, she's on now, so thank you so much. So I will go ahead and just, for the sake of time, I'll introduce all of the members of the Makita team that are joining me today virtually, and then a number of us will be presenting our presentation to the committee. So I'm Mika Malone, a consultant in Makita's Portland office, and as noted in the preamble, I work on the WRS relationship along with my colleague Nick Erickson, who is also online today. We, in this case, as you noted, are reviewing the State Treasurer's Office and will be providing our review and observations on that. We're joined by several other members of our team. Susan Brumbaugh is joining us from Boston. She assisted and oversees all of Makita's performance reporting groups. She does not work on the WRS relationship directly, so she helped oversee kind of quality control in terms of performance review and processes. So she'll be walking through our review of performance and methodology in a little while. We're also joined by Inwoo Huang in our Portland office. He works on the WRS relationship, but assisted with the incentive compensation review here. Henry Lopez assisted with our performance review and is on, and Owen Lingenfelder also assisted with providing information to RVK for their report and working with the project team. So the way that we were hoping to present this morning, and I believe that Karen has offered to share the screen. So thank you so much. We'll be sharing the report that we submitted in early October to you all. What I would like to do is spend a few moments on just describing the process that we went through to complete the project at your request. Then I will turn it over. We'll move through the sections aligned with the scope of the project. So after I provide that introduction, Nick will walk through the review of benchmarks that was a component of this review. Then Sue will walk through our performance and methodology review. And then I will wrap up with the review of the incentive compensation program. We obviously welcome questions throughout. So please, if you need clarifications or have any questions about the work, we'll try to take breaks and stop within each section to receive feedback, but if we don't hear you, please either raise hand or let us know how we can respond. At the end, we'll certainly finish well within the time that was allotted to us and have plenty of time for questions at the end as well. Does
Sounds
that
great.
work? Okay.
That works perfect. Please proceed.
Great. So thank you. If we could pull up the presentation and turn to page 4 of 104. Great. So thank you. So just as by way of background, I wanted to highlight kind of the timeline that we conducted this project within. I know you're all likely aware, but as we walk through it, it will become relevant to the scope and how we worked with our team, with the team at RVK, and with the State Treasurer's Office to provide and conduct this review. Ultimately, one component of the review that made this easy, as noted earlier, because Makita and RVK are engaged by the two investment offices, we share a common reporting system, which we'll refer to in this report as PARIS. PARIS is a very common industry provider of performance reporting and information. And because both firms use that same platform, it did make some of the data sharing both simpler as well as, from my perspective, have very good quality control because it's coming through a third party where both Makita and RVK are inputting data into this system. And then when we each released that data to each other for the purposes of this project, Makita had the ability to utilize that PARIS report to review and in some cases audit the data that was provided. So over the course of the summer, we received the contract from the Legislative Services Office. we began collecting data from both Paris, as I just mentioned, as well as several other locations, including from RVK directly. We also, if you move forward to page 5, just highlight that through the course of this project, we also conducted a series of interviews with RVK staff, with Treasury staff, and then internally had many dialogues in order to make sure that we had the appropriate data, a lot of email interaction also with RVK and the State Treasurer's Office to ensure that we had all of the data that we needed in the format that we needed it to be able to conduct the review. And I'm really happy to say that I think that that process went as smooth as one could hope, given sort of a consolidated timeline to do this review. I also wanted to note that while this, I believe, is the first time that the state of Wyoming is having kind of outside parties review the work of consultants for the State Treasurer's Office and for the WRS, in our experience, it's relatively, relatively common in the industry to have a third-party check of these types of things over time. So we have had the opportunity to do similar work in the past with other organizations and felt that this went at least as smoothly as those engagements have in the past. So very pleased to present our findings today. On page 6, we highlight the observations and recommendations in executive summary format. Just a couple of things to note here, because we will go through each of these in the context of the broader review, but wanted to highlight that overall, we found the integrity of the data to be strong. We found the access of the data to be strong. And what, if I could leave this committee with one takeaway, it is that our conclusion is that the data provided was accurate to the degree that we could observe it. We don't have any concerns about where that data comes from and how it is presented. Most of our findings or recommendations for consideration are related to going forward. You've now had an incentive compensation program in place at both of these investment offices for a number of years. This was a chance to have kind of a third-party set of eyes on each of our work. And I think that's always a good opportunity for those on investment staff and the consultants on the other side of the table to have the opportunity to take a new look at benchmarks, to consider how the industry is evolving. I know that at WRS, there is always an annual process to review asset allocation and benchmarks. I believe the same process takes place at the State Treasurer's Office. So these are opportunities to highlight some of our observations for consideration by the various committees and boards going forward. If we look, so beginning the methodology component of this review, before I turn it over to Nick, just a quick timeline on page 9, just to give a sense for what the engagement looked like and what the data request flow of information looked like as well. So this is more of an eye chart than it is something that you need to read line by line, but just wanted to note that effectively we had contracts signed sort of at the end of July, ultimately spent the month of August getting data requests in place between Makita, RVK, Paris, and each of the broad players. And then that data was really received kind of late August when we got access to the Paris data for the State Treasurer's Office. And that's really when the work of auditing the performance and moving through the process began in earnest. So sort of about a month of setup for the project, discussions related to ensuring the data integrity came over from both sides clearly, and then really about a month with that data to review it with our internal teams. So throughout the month of September, we were evaluating all of that data, communicating with staff, and again, with Sue and her team walking through the process that we would undertake basically if the State Treasurer's Office had come on board as a Makita client, right? So ensuring that we had access to all of that Paris data, could replicate the various performance reporting methodologies and outcomes. And then we provide a summary within this report of any places where we needed to come back to RVK to ask questions or receive additional clarification about the performance stated. I will note that there is one component of this review, and really we could move to page 11 for this comment. The one component of the review of the State Treasurer's Office compensation plan that's a little bit different than I think what you'll hear from RVK looking at WRS is that while both funds present performance information publicly, you have access to all of that data. There is also, for the incentive compensation program at the State Treasurer's Office, like we see in other public funds, there are some investments that are excluded statutorily or excluded due to the time horizon of staff in place and what's there. So there are effectively two sets of performance reporting data that are utilized to conduct that review. So we'll get into that a little bit more later, but I did want to highlight that it adds an additional layer of complexity in reviewing the performance reporting because we have one set of data, which Sue will walk through momentarily, to review performance reports that move through the process. And then there's an additional set of data that RVK creates and is reviewed in order to calculate the incentive compensation for the staff. So just wanted to highlight that's one difference, I think, between the two organizations. On page 11, we highlight just the methodology used in each of the scope areas. And again, the request was to utilize 2023 as an audit period, so very deep dive into the data for that period, both from a performance standpoint and an incentive compensation standpoint, and then a performance review for the other 3 years in question that incentive compensation has been live. So for 2020, 2021, 2022, we reviewed that data, but not in quite as much detail as we did for the audit period. So wanted to highlight that as well. Within the incentive compensation review, we also provide some context around what we at Makita see broadly in the industry from an incentive compensation standpoint. It has become a tool that is used at more and more public funds around the country. So we provide a bit of context there as well. So before turning it over to Nick to walk through our review of benchmarks, maybe I'll pause and see if there are any questions about just the structure or the scope of the project and how we conducted it. Hearing none, I will turn it over to Nick to walk through our benchmark review.
Great. Thank you, Mika. And I just want to echo Mika's comments and thank the Select Committee on Capital Financing and Investments for having Makita present today. I'm going to start on page 14, and the way I'll sort of organize my comments are in 3 primary sections, one being kind of the process we took to review the benchmarks for the various asset classes. I'll give some background information on how the institutional marketplace thinks about benchmarking each asset class. And then at the end, I will summarize some of our findings on just a couple benchmarks that we noted for further conversation. So when we think about the process we went through, we reviewed all the benchmarks and they were all taken from the investment policy statements. And we reviewed the investment policy statements over the last 3 fiscal years or so. And when they changed over time, we noted that. The Wyoming State Treasurer's Office, like many institutional portfolios, utilizes a total fund policy benchmark that to assess the performance of the portfolio over time. And this total fund benchmark is a weighted average of the underlying pool benchmarks. And within each pool, there's a specific benchmark applied to each asset category. When we think about benchmarking, there's sort of 3 levels that you can apply a benchmark to: the total plan, each of the individual asset classes, and then each manager as well. And for this review, we didn't assess the manager level benchmarking unless those were the same benchmarks for an asset class that then rolled up into the total fund benchmark. So, to give a little background about how we think about benchmarking and how the institutional marketplace thinks about benchmarking. There are 2 main sort of widely accepted schools of thought in determining benchmark criteria, and these start on page 17. The first is the Bailey criteria, and there's 6 primary characteristics in this criteria, and that's on the next page here. The 6 characteristics are: the benchmark should be unambiguous, it should be investable, it should be measurable, It should be appropriate for each asset class. It should be reflective of the investment options within that asset class, and it should be specified in advance. The CFA Institute, which is also an organization that I think many investment consultants in the institutional marketplace are familiar with, has 5 characteristics for appropriate benchmarking. One being the benchmark is investable, the benchmark is accessible, the benchmark's transparent, it's independent, and it's relevant to the underlying assets within that asset class. So these
Mr.
two,
Chairman, Nick, we have a question. Go
Sure.
ahead, Representative Larson.
So if you could go back to page 17 and you say specified in advance, could you help me understand that as that relates to the IPS? So is it, we're saying that all the investments within the investment policy statement are probably the specified in advance, and anything outside the IPS may not be specified? Or help me understand kind of what your thoughts there are.
yeah, on page 17. So as we'll get into when I further talk about some of this criteria, this says that the benchmark should be specified in advance, meaning you have a good idea of the underlying securities within each benchmark prior to any evaluation period, meaning that following, say, any given quarter or any given year, assets that aren't similar to what the benchmark is reflecting are not then, added in or subtracted out after the fact. So it's the idea here is that it's established before the evaluation period, and that's because you wouldn't want to necessarily then have the benchmark change following any given time period in evaluation.
And Nick, if I could add on to that, I think that this aligns maybe to the question. The investment policy statement for the Treasurer's Office does outline the benchmarks utilized for each of the areas, and Nick will walk through that in a moment. It's also required by the incentive compensation plan, the performance plan, that those benchmarks are identified in the year prior to their utilization. So in that way, you sort of already check that box in terms of the benchmarks that are utilized for your program being specified in advance.
Follow up, Mr. Chairman. And so am I understanding correctly then that your benchmarks would align with your IPS, with your investment policy statement on, is that correct?
Correct.
And then any investment outside that investment policy statement wouldn't be considered in your benchmarking?
In an ideal, so I think Nick's walking through, what we view as the industry standards for benchmarking, and then he'll get into the specifics of the STO portfolio. But I think that that's an accurate statement.
Other questions? Okay, seeing none, Nick, please proceed. Thank you.
Great, thank you. So, these characteristics are on page 17 and following on page 18. There's certainly some overlapping characteristics and concepts among both of these sets of criteria. One of those is, of course, the benchmark being investable. And I'll talk a little bit about how any portfolio, any diversified institutional portfolio will have underlying benchmark components that fail one or more of these characteristics. So to kind of give an example here, I'll pick on private markets asset classes because they are notoriously difficult to benchmark. By nature, by name, these are comprised of private assets, which are not available for anybody to invest in. Myself and yourself and cannot invest in private markets. However, institutional portfolios can. So they are not necessarily investable. You can't buy an index fund that tracks the private equity universe, for instance. And when we think about benchmarking private markets asset classes, the two main forms of benchmarking that institutional portfolios will use for private markets asset classes are, the first one is a composite style benchmark made up of similar private market funds. And these come from providers such as Cambridge, Preqin, Burgiss. The other often used style is to use a public markets equivalent plus a premium. So in the case of, say, private equity, a US-based private equity fund, you might use the Russell 3000, which is a benchmark, a broad benchmark of US stocks, and then add a premium on that to compensate you for the illiquidity that you get investing in private markets. So maybe it's the Russell 3000 plus 2% per year. Now, both of these styles of benchmarks, whether it's the composite style benchmark from somebody like Cambridge, or whether it's a public markets benchmark plus a premium, they both fail the investable characteristic. And that's because you cannot invest in a, say, ETF that follows the Cambridge benchmark, and you can't invest in a premium over, say, the Russell 3000. You can certainly buy an index fund that tracks the Russell 3000, but you can't buy one that then is expected to earn 200 basis points over that. In addition to the investable characteristic, you might say some of these fail other characteristics listed in these criteria, such as being accessible. We certainly know that the composite style benchmarks from Cambridge and other providers here do come with some fairly high licensing fees, so they aren't necessarily accessible for everybody out there. So it's really critical to understand that many commonly used benchmarks fail one or more of these tests, and thus the total fund benchmark, which is made up of a lot of these underlying asset classes, will never be a perfect comparison for an institutional fund's diversified asset allocation. And that's because often diversified institutional portfolios, such as the Treasury, such as Wyoming Retirement System, do have private markets and other alternative assets within the policy targets. So knowing that benchmarks often fail one or more of these criteria, we also focus on the process of how the benchmarks are selected. So we reviewed this for the State Treasury Office portfolio, and we looked for things like when benchmarks were changed or benchmarks were instituted, was there an open, transparent conversation? Did a third party concur with the benchmark recommendations? Is the benchmark publicly listed in investment policy statements? And is there maybe a simpler approach that maybe a better fit for various asset classes? Now, when we think about simplifying a benchmark, often what we see is that you will sacrifice simplicity for really the fit versus the asset class. And so sometimes maybe a simplified approach for any given asset class isn't the best option, but we want to make sure that those conversations occur. So even following a perfect process, even following all this criteria, you are still going to have benchmarks that may not be perfectly right, and that's very common in our business. And what we found here is that there was a collaborative approach to benchmark selection. All of the benchmark changes were noted in memos. There was reasoning given behind selecting these benchmarks, and all of the boards governing the State Treasury Office portfolio have the opportunity to review these benchmarks when they were instituted. So to get into kind of the wrap up here on benchmarking, through pages 22 through 41, we summarize our findings and we go through asset class by asset class. I wasn't going to cover every single page, but I will highlight a couple of these. But really, based on our assessment, we did not find any demonstrated likelihood of the ability to manipulate outcomes of reporting and performance data, because the third-party consultant responsible for calculating and reporting performance, as well as the recommending the benchmarks, concurred on a lot of these, and we found that there was an open conversation to select various benchmark. And from a staff perspective, we did not find any evidence that calls into question the presentation of any data. We did, however, find two areas that we wanted to note in the total plan benchmark that maybe warrants future conversation. And we think it's also just good practice, good governance practice to review your benchmarks every year, whether you do it during the asset allocation review process, whether you do it during the review of the investment policy statement. And a lot of that's because the institutional marketplace and the benchmarks that are applied to various asset classes, they're constantly changing. And in the case of private markets asset classes, a lot of these benchmarks for underlying private markets, the smaller asset classes, I would say are maturing and they're becoming more robust over time. And so while sometimes a private market asset class may not work, a few years ago, it might work for a few years from now. So the two areas I thought I would note today, one is within real estate. The State Treasury's Office has an allocation to core real estate and also an allocation to non-core real estate. Both of these areas are benchmarked to the NCREIF Odyssey benchmark. NCREIF stands for the National Council of Real Estate Investment Fiduciaries, and the Odyssey is the open-end diversified core equity. And when we think about non-core real estate, these are typically buildings that need some sort of renovation, or even maybe they are development opportunities. Non-core real estate funds, general partnerships typically come with a higher risk and return profile than straight core general partnerships. So we believe that it might be a good idea to have a conversation during the next investment policy statement review or during the next asset allocation review to see if that is really the best benchmark, given how some of these non-core private markets benchmarks have evolved over time.
Nick, we have a question. Go ahead,
Sure.
Senator Hicks.
Yeah, thank you, Mr. Chairman. Nick, so when we look at that and in your recommendation or your consideration, not necessarily a recommendation to consolidate some of these, how much would that be affected in the future, and would that recommendation stay as we change asset allocations? And so currently, if those are balanced asset allocation and we consolidate those into one benchmark, but then that asset allocation changes over a period of time, does that affect to change that potential performance level?
Every time you have an asset allocation review and every time you change your asset allocation, whether it's removing an asset class or changing targets, it's a good idea to then do a benchmark review to make sure that it is appropriate. If there was some sort of consolidation or simplification of the asset allocation or the benchmarking, what we do find sometimes is that when you do seek to simplify a given asset class or an asset class aggregate and apply a new benchmark there, oftentimes you give up sort of the best fit of various asset classes. So it could certainly change relative performance? Yes, it can, but those are the sort of conversations we believe it is prudent for the boards that govern the State Treasurer's Office, as well as staff and the external consultant. Mika, I don't know if you want to jump in there too as well.
Maybe the only thing that I would add to that is that anytime a benchmark is changed, and part of our review was to ensure that this was the case, but what you do is link all of the historical benchmarks. And so any change would only be prospective, as opposed to changing or consolidating a benchmark and then applying that historically. So in that way, kind of getting back to that setting benchmarks at advanced conversation, we'd want any consolidation to be discussed and then implemented, and then only future measurement would be considered relative to that new consolidated benchmark.
Further questions? Okay, please proceed, Nick.
Great, thank you, Mr. Chair. And the other asset class outside of non-core real estate is on page 39, and this is also an area where benchmarking from private markets providers is evolving over time, and that area is private infrastructure. So when we think about infrastructure within institutional portfolios, it's typically there for diversification, it's there for inflation protection, stability of income. And the underlying investments might be things like airports, ports, data centers, toll roads, bridges. And the vehicles that typically institutional funds will access infrastructure through are something closer to a core private real estate, or even value add or an opportunistic real estate fund. We noted for the State Treasurer's Office portfolio, there's a less common benchmark that's used there. It's the 10-year U.S. Treasury yield plus 350 basis points premium on top of that. While this isn't common, we do believe it is reasonable. And the idea there is that when because of the inflation protection characteristics of infrastructure, when we see inflation pick up, often interest rates also increase, which would mean that the 10-year US Treasury yield would increase over time. So from that perspective, theoretically, it does seem like a good fit, but then you look at the underlying assets. Of course, US Treasuries are not infrastructure investments. And so, this is an area that, we would flag for future conversation, especially as some of these private market benchmarks evolve and mature over time. There may be more underlying general partnerships within these infrastructure benchmarks. You can get a more robust data set to compare against. We might not be there yet, but it's certainly a good conversation to have. Other options there would be, outside of a private markets benchmark, which are becoming more mature. You could also do something like a public markets benchmark plus a premium. Certainly, I think in those areas you might have performance dispersion over short-term time periods, but over the longer-term time periods, both of those could work. But again, this is an area where, we see a lot of the private market benchmarks just don't have a lot of components yet. And so this is an area I think to watch, along with all your benchmarks. Watch them over time. It's just good practice. I will note we have every asset class listed in the investment policy statement as its own slide within the review. Again, those go from pages 22 through 41. For time's sake, I wasn't going to review all of those, but happy to take any questions.
Committee questions up to this point? Of our online participants, any? Can't see all of you, so you may have to speak up. Okay, I think we're in a good position. Please proceed.
Okay, thanks. I will take it from here, and if you could move ahead to page 46, that would be great. I'd like to start out by saying that performance analysis is really central to the prudent management of investment portfolios. There are two important components to this process, which are things we looked into, of
Sue,
course.
could you get a little closer to your microphone? We're struggling to hear you in the
Oh,
room.
sorry.
Yeah.
Okay.
And it might
that
be on
work any
our
better?
end, but
Can you hear me now?
we'll see if we can turn it up on our end. It may be on our end.
Okay. So let me go back then. Let me start out by saying that performance analysis is central to the prudent management of investment portfolios. And there are two components to this process. First is to have clearly defined best practices and adherence to those best practices. Also, those best practices should follow industry standards and methodologies. The second part is the integrity of the data. And a consultant should be committed to ensuring the accuracy of the data collection, data aggregation, and finally, the data presentation to clients. So the first part of the scope of our work on performance returns was related to the first component I just mentioned, to review the methodology used by RVK. Before we get into that, I just wanted to go over a couple quick definitions in case people aren't familiar with those, and just to make sure we're all on the same page. The first is modified DEETs. Modified DEETs is essentially a time-weighted return that's commonly used to calculate public manager returns. And it neutralizes the impact of cash flows into and out of the portfolio in any given time period. The idea is that portfolio managers can't control those flows in and out, so we need to neutralize the effect of that. The second one is a money-weighted return, which is more commonly used for private market investments. This is a compound rate of growth given the timing and magnitude of all the cash flows in a given period. And then finally, total return, and that's simply how we roll up the underlying investments to get an aggregate. You can roll up to an asset class, you can roll up to the total fund, and there are several ways you can do this according to guidance from the CFA Institute, and I'll just get into that detail in a few more moments. You can flip to page 47. And this really gets into the objective and project and our observations. So Makita was contracted to review the reported investment performance for the fiscal years 2020, 2021, and 22. To do this, we received Paris data directly from Confluence, as Mika had mentioned earlier, and we use that for our review. So again, we're both using the same technology called Paris, And it just made the sharing of the data a lot easier for us to be able to do our review. For the years requested, we basically looked at the methodologies used by RVK, which included the performance calculations on the individual investments, and then the performance calculations at each rolled up asset class level, and then at the total fund level. We validated all the data that was used in the calculations by tying this back to the custody bank statements and manager statements, and we reviewed the policy and custom benchmarks. So first focusing on the methodologies, Makita found that RVK uses methodologies that are consistent with standards, with market and industry standards. They use a modified DEETS calculation for public market managers. They use modified DEETS roll-up for total fund and for asset class levels. And they enter interim market values for every cash flow. Again, each practice is widely used in the industry. While the methodologies are consistent and accepted with the industry, we noted several observations of RVK's work. So actually, I'm going to skip to the second observation. So if you could just flip to page 48. Thank you. So usually a firm will define a large cash flow policy, meaning when a cash flow is greater than a certain percent of assets. When that occurs for an individual investment, an analyst is required to enter an interim market value, meaning the market value at the end of the day that cash flow was received. Then a sub-period return is calculated. And then finally, those sub-period returns are linked to get a true time-weighted return. So for example, we get a large cash flow today, which is October 30. We would calculate a return from October 1 to October 30. And then we would calculate another return for October 31, and we would link those two. Makita's large cash flow policy is 10%. RVK doesn't appear to have a large cash flow policy. What they do is instead enter interim market values for every single cash flow. So while it's not incorrect, it's perfectly acceptable to do it that way. We just feel it's a little bit maybe unnecessary to do that. So it just could create additional work. So that was just one of our observations. However, if we back up now to the first observation, if you go back to page 47, I think this is where there's another observation. So Makita uses a different roll-up than RVK does. RVK uses a modified DEETS roll-up, again, perfectly acceptable with standards, industry standards. Makita uses a weighted average calculation. So where this is a little bit of a difference, when there are no significant cash flows, these will result in little difference in calculated returns. Where they might differ is when there is a large cash flow of a certain magnitude, usually probably over 10%. In this case, there's a little bit of an imperfection with the Paris technology. The average weighted cash flow roll-up is actually capturing all of the interim market values and the true time-weighted return. That's rolling it up. The modified DEETS calculations that RVK is using, it doesn't roll that up. So it's kind of missing some of those large cash flows and some of the magnitude of those cash flows. So that was another observation. Finally, if you flip back to page 48, Makita observed that the Wyoming State Total Fund Index and Plan Policy Index used by RVK follow an appropriate model, and they're aligned with constituents outlined in the IPS. Minor discrepancies were noted, but subsequently reconciled, and these are mostly due to the underlying constituents being updated by Paris vendors, which is not an uncommon occurrence. That happens quite frequently. The next couple of pages are validation of those performance calculations. In the interest of time, we don't really have to go through that. If you could flip forward to page 52, that would be great. Along with reviewing the methodologies, part of the scope obviously was to audit the data related to the performance calculations. So for the fiscal year 2023, Makita randomly selected a subset of the data. We selected 25% of the managers on the roster, making sure we selected some from each individual asset class. We had gathered all the statements from RVK for the corresponding time period, so it made the selection easy. At the end of the day, we ended up reviewing 28 statements for each month, so 84 statements. After we reviewed the data for these investments selected, We looked at the market values, the cash flows, and the returns. For all of the data collected, we were able to tie that back to the Paris reporting platform. So again, integrity of the data is a critical component to accurate performance calculations, and we found that all the data was accurately accounted for as reported by the managers or the custodians. The next couple of pages really just get into some visuals, and to be honest, some of the minutiae related to the data validation. We're simply showing screenshots of the Paris reporting platform, and we're tying that back to the statements that we received. Makita took an additional step and used Excel to go ahead and manually calculate that same performance return offline to validate that we were getting back to the same number. So we don't have to go through those. But in summary, Makita's observations and findings are that RVK is following protocol of accepted performance return calculations and data aggregation. If there are no questions, I'll pass it back to you, Miko.
Any questions from the committee before we move into the incentive compensation review, which is the final piece? I know that we're kind of running up against time and want to be respectful of the committee's time as well.
Seeing no questions at this time, please proceed.
Great, thank you. So this section of the review begins on page 65 of the Makita materials. And I want to note a couple of things at the outset, just in terms of considering the magnitude of these programs and the overall suitability of them. One, incentive compensation has become, if not a requirement, certainly a dominant force in the ability of various public fund programs to attract and retain employees. So this group worked through that process 4 years ago and implemented incentive compensation. So Makita was reviewing that 4-year period, checking the calculations and information, obviously leveraging all of that work that Sue highlighted in her performance evaluation. And as Nick highlighted in the benchmark review, right? A piece of our work is really to ensure that all of the components of data that feed into that incentive compensation process each year are accurate, because then we can go into kind of the final stage, which is confirming that the calculations themselves, if you have good data and that data is reporting accurate performance information, now we take the incentive compensation program, analyze it, and ensure that the output of that is also accurate. So first and foremost, our review showed that we felt comfortable with the output of that data. I did note in my introduction, and we'll highlight again here, that we were not able to validate with specificity every single underlying component of the incentive compensation review, primarily, and I think that we highlight this on page 66, primarily because there are investments that are included or excluded in the incentive compensation program that are different from what Sue mentioned in our standard review of the Paris data. So what we found is that the tracking of all of that information that RVK creates and provides has good basis. We were able to go back and confirm market values, I believe with no exceptions. So the only places where there were any inconsistencies in our review were really places where you would expect them to be, right? The overall asset class roll-up in Paris is going to not match a roll-up for an asset category where, for example, in the private markets, some investments are excluded statutorily, or where another asset class is not included. So these were things that we expected going into the review. We found them. I will also note that one additional complication, and this is highlighted here at kind of the bottom of 66, because of the irregular periods that are utilized, the state treasurer's office is trading securities within the team. And because of the rebalancing periods that are required there, it doesn't align as well with, say, a traditional monthly portfolio, which is what you would see in traditional performance reporting. So those periods at the rebalancing points create, again, kind of one additional layer that our team had to work through in trying to assess whether the performance was accurate. Again, and you see several pages of kind of commentary around what that process looked like. But ultimately, we discussed with RVK, there was a lot of conversation to understand the process, the reasoning behind the process, and then ultimately the numbers that fed into that process. And Makita was satisfied in the course of our review that there was no effort to manipulate any of that data, that everything was calculated and reviewed and provided to the various committees that oversee the incentive compensation program accurately. So I wanted to highlight that because you see a lot of commentary around what that looked like, where we found small exceptions and reviewed them. In none of the work that we did we find that any of those places where we couldn't corroborate down to the penny a number, we do not believe that there would have been any impact on the incentive compensation available to staff. So I want to be really clear that there were no cases where we felt that there were numbers that had we been able to get different access would have changed the outcome of the incentive compensation program. And just as a quick snapshot, when we think about the incentive compensation program itself, the State Treasurer's Office portfolio, based on its total fund benchmark, generated about $600 million in alpha, in outperformance over those last 4 years. There is a component to the performance compensation plan that allows for only up to 2% of alpha to be payable out to employees over those periods. And so the actual payout over those 4 years was a little over 2.8 million, 3.1 million would have been the maximum. So just kind of putting those numbers into context kind of helps give you a sense for where, the ability to bring those employees on, the performance of the overall plan has hopefully resulted in, I think, the goals of the program to begin with, which is attracting and retaining good quality professionals and resulting in good performance for the State Treasurer's Office. We did have a second component to our review, which is thinking about the incentive compensation program a little bit more broadly. But before I just walk through that, maybe I'll see if there are any questions about the calculations themselves or how we audited those in our review.
Questions, committee? You're doing great. Keep up the good work and please proceed.
Great. Well, just 3 slides left and we'll wrap this for you. So on page 70, we highlight and this is Makita's view of kind of the broader incentive compensation marketplace. So wanted to highlight this just to compare and contrast it with the way that the State Treasurer's Office conducts their incentive compensation program. Right now, the incentive compensation program for the State Treasurer's Office includes 50% of compensation related to total fund performance, and then 50% of the incentive compensation is allocated based on the asset classes that those investment staff work on. This is a very common approach in the industry. We see it predominantly in the large public fund space. I wanted to highlight that in my work over the last 2 decades with public funds, I have seen a shift towards a focus on just total fund benchmarking and somewhat away from the asset class level compensation. And that is really only because it can create an environment of, one, it adds complexity to the calculations, and some plans have wanted to move towards a more simplistic structure. And 2, in some cases, not in all cases, it can result in an environment where depending on the asset classes involved, when there's cyclicality of returns, you can create an environment where certain asset classes are being paid out either more or less consistency. You particularly see this with respect to private market asset classes, which tend to take a long time to get to a period of outperformance and then take a long time to move to a period of underperformance, depending on what the market cycle looks like. And so when we highlight the strengths and weaknesses of different approaches, I just wanted to note that that's what we see in the marketplace. So one, some groups don't use incentive compensation. Obviously, prior to 4 years ago, what that type of a program looks like. I would say the successful places that don't use incentive comp have moved to an indexing approach to compensation, which means that their salaries try to at least be median among other public and private investment offices. And that's a challenge. That can be a challenge legislatively. It can be a challenge to get the budget for that. So I think that that's where a lot of groups move into the incentive-driven approaches where you have asset class or total fund based. So as I mentioned, Makita's bias is towards total fund base. But again, I see very commonly the asset class component utilized. We don't have any problem with it. I just believe that continuing to assess, now that you've had this program in place for 4 years, what the best approach is going forward is really the work for everyone involved with both of these two funds to think about what can make the programs better on a go-forward basis. So if you look at page 72, just kind of final recommendation here, there is one place that I think warrants a little bit of attention. And I just, for what it's worth, I think this is true for both the state treasurer's office and for the Wyoming retirement system. You know, you've had 4 years now of incentive compensation. A 3-year time period is utilized in that review, which was perfectly appropriate, and it was phased into over time as these programs were launched. Now that you'll be approaching 5 years in each of these two programs and you have the ability to assess longer term data, we find that it is appropriate to consider whether adding a 5-year metric or replacing the 3-year metric with a 5-year metric may be appropriate. Again, you have to think about things like, have you had tenure of staff over that time period? Is it appropriate to measure them over that time period? But I believe that as these programs continue to grow and evolve, it's always good if you can continue to look at a long-term time horizon as much as possible. So that's really the conclusion of our incentive compensation review and recommendations and our overall review of performance for the state treasurer's office. But happy to take any questions from the committee.
Committee, questions? Representative Larson.
Mr. Chairman, I'd like to go back to, now that we finished this, going back to some of the first comments that they made, and they talked about transparency, and I read in there, it appears that the state treasurer's office provides reporting on a quarterly and annual basis. So is that part of the transparency that is available to the public, or how, and they do that on, can you help me understand on what basis they do that and the relevance of that?
Yeah, so I'm happy to weigh in, and maybe others will as well. I believe that for the state treasurer's office, there is access online to quarterly performance data as reported by RVK. So you have the objective third-party review of performance that's available. And so that transparency is there for the public. I believe, as with most programs, there are likely monthly reviews that are going on and reconciling data on an even more frequent basis, but quarterly and annual reports are available to the public on the website. And I think that is a key component of transparency for any program.
Further questions? So I think the next question I'd have would be for the brief statement from the treasurer's office. And really the question I would then have for the treasurer's office is, based on the recommendations made in this audit, what are some of the changes you see yourselves making going forward?
Mr. Chair, Madam Co-Chair, my name is Patrick Fleming. I'm the CIO for the Treasurer's Office. The Treasurer said that I could start, so I'll comment on that. First, I do want to just comment on Representative Larson's comment there about transparency. And one thing, just to mention that we were voted the #4 most transparent fund in the world, #1 in the United States. So that is something that we are really proud of. And as Mika mentioned, you know, the quarterly annual numbers that you can see on the Treasurer's website, you can also see monthly numbers. So we have monthly, quarterly, and annual numbers that are on the website. So any legislator, any citizen of the state of Wyoming can view those at any time. They show all of the things that we're doing, our managers, our returns, everything. The same data that we all use, everyone gets. So that's something we're really proud of, and the treasurer has really focused on keeping that transparency. So kudos to the treasurer and his focus on doing that. Just a couple comments on the report. One, I want to thank the Makita team for doing this. They, I thought, did an excellent job, but just highlighting the main point that they said, that there is no evidence whatsoever of any manipulation, blah, 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 blah. And again, I have mentioned this before, but when you're looking at this, you know, they made the statement over the last 3 years, we produced, you know, 601 million in alpha or whatever, but that's only in the part that were benchmarked in the performance compensation. It doesn't account for all of the other alpha that we have produced. And so last year, we have the final numbers from June 30. The total fund had a alpha performance of 150 basis points over the index. On $30 billion, that's $450 million. So the total performance compensation, I think is between $3 and $4 million. Is that correct, Don? $3 to $4 million. And yet we produced, you know, over 400 million, let's say. That is the single best investment that the state has ever done, in my opinion. And it's the same for WRS. So when you actually look at whether or not this program is successful, I think not only is it successful, but it's a screaming hit. And I just want to make sure that everyone understands that when you look at this, it pales, the payout pales in comparison to what we actually did. So I just wanted to highlight that. But the other side of it is Makita raises some very good points. And I just want to highlight some of those real briefly. So total fund benchmarking, it's as she mentioned, it's really difficult to look at this. There's all kinds of other things that we can look at, but we could simplify it, but it's, you know, going to be at the margin. They commented about issues with preferreds. That's out the window. We're no longer managing in a preferred index, so that's gone. The one that I really want to highlight is the Odyssey, the real estate component. So we have about 1.3 in core and 600 million in non-core. So this is clearly an issue that we missed. And I'm glad that they brought it to our attention, because this highlights some of the things that we've talked about before, where whether it's performance or total benchmark, we're looking at that 600 million as a core fund. And so whether our risk reports or performance is looking at core. And that's not correct, because core Odyssey has a leverage of about 1.25 times. It's very conservative. Non-core, the average is about 1.6 times. So much, much higher leverage, and you should get a higher return for that. That is beta, not alpha, and that is something that's not correct, and we will address that. So our plan for addressing these will be, as Makita mentioned, during our normal IPS reviews and so forth, but all of the things that they brought up on the suggestions we should look at, we will bring up, and I promise you, we will address this Odyssey issue, because it's not right. We should not be paid for that. And our manager, you know, Robin Preston, who looks at this, he was like, you know, absolutely, yeah, I didn't even really know. It just slipped us, but thank you for bringing it out. But one, I want to thank Makita for highlighting something like that. And, you know, from one point, the risk, there's much more risk than what we're monitoring because of that. And two, we should not be paid on beta. It's only alpha, and that's not correct. So we will correct that. The amount that you're talking about, you know, is de minimis, because it's, you know, instead of Odyssey, maybe correct one would be Odyssey plus 50 or 100 basis points to compensate that, but it should be adjusted and be corrected. So that is something that was highlighted and will be corrected. So with that, I'll stand for any questions or pass it to the treasurer for any comment.
My follow-up question or other question would be, would you have positioned your investments as you did if performance compensation wasn't on the table? If you were just a paid employee and the state did what it did investment-wise, would this have been how you had positioned the investments?
Mr. Chairman, absolutely. And the reason why I commented on that first part about the 600 million over 3 years, well, we're not paid on that difference in what we did this year or last year, ending June 30, you know, the 1.5% or 2.2 in the permanent funds. A lot of our assets are not in the plan. And yet we don't care. We're focusing on producing alpha. We could care less whether it's in the plan or not. We are trying, our number one thing is to produce alpha, and that is what we're focusing on, highest risk-adjusted return. And so whether it's in the plan or not, we wouldn't care. So here's a highlight on the Odyssey. If we were really trying to game the system, we would have, you know, we're way underweight. We should be equal weight between core and non-core, the 1.3. We're way underweight non-core. If we were really trying to game the system, we would have been jacking up the non-core assets. And yet, you know, Robin Preston was saying, you know, real estate is going to be challenged in this environment, and we want to be underweight. So we've had a significant underweight to real estate in this period, especially the most levered part of it, the non-core, which will go down more than the core in this time. And so, you know, and why? You know, we're not paid on it. You know, but that change underweight, overweight, he's not paid on that just because of the way the structure is, but it's best for the state, and that's what our focus is.
Very good, thank you. Senator Hicks.
Yeah, Patrick, would you like to opine on the recommendation to move from the 3 to 5 year term performance compensation? The recommendation, your thoughts on that?
Mr. Chair, Senator, when we first started this, we didn't have the ability to go back and look. So going on an ongoing basis, now that we have the years to go, yeah, I'm indifferent. Whatever the IFC and the SLIB would think is best, we don't care. Yeah, our focus is just to produce alpha. We don't care the 1 year, 2 year, 3. Yeah, we're going to just try and beat it every year.
Yeah, Mr. Chairman, and so just to follow up on that, do you see that there is some advantages because of the longer term horizon to maybe keep and retain employees, knowing that if this is now going to be averaged over a 5 year period, or does that make any difference whatsoever?
Mr. Chairman, Senator, yes, there already is a bit of a smoothing in there, but anytime you can smooth those returns is highly advisable. So, you know, for instance, Mika commented on the private infrastructure benchmark. I can't stand our benchmark. It's U.S. Treasuries plus 350. And I fought tooth and nail saying, it will always be positive. U.S. Treasury 10 years will always be positive. So what are they, 4.25 this morning, you know, plus the 350. So that benchmark is always going to be positive, and yet infrastructure, we know, will never always be positive. Always and never, two bad words to use. So, you know, those are things that we look at, and I would love to change that benchmark to have something that's reflective of the investments. But, you know, your point, having that would smooth out those periods of when the infrastructure benchmark was negative, and yet, you know, treasuries are still positive. Treasuries plus 350, unless we go to massive negative rates. It's highly unlikely 10 years are going to be ever negative, in my opinion.
Further questions? Looking at our committee online, not seeing any coming from them. Further questions from the committee on the Makita report regarding the STO performance compensation? Yeah. Senator Furphy.
Thank you, Mr. Chairman. Patrick, I'm always a little confused on these benchmarks about, they really don't seem to compare the risks involved. Would you comment on that?
Mr. Chairman, Senator, absolutely. That is the part, I think Makita was talking about the complexity in the benchmarks. And that is something that we've gone over the top to make sure that the risk that RVK is showing that we're able to do, you know, the 70-30 reference, in every fund, you have a 22% vol, and in the permanent funds, every fund has a certain risk limit. So that is something we think is extremely important. And so the key is, if your benchmark is the S&P 500, you're only investing in S&P 500 stocks. If the benchmark is the Odyssey, you're only investing in Odyssey funds. As soon as you stray outside the benchmark, and there's a difference between your benchmark and what you're actually doing, you put in an inherent risk that is not being monitored by the consultants. And so I would take exception to say, I think that, we are extremely cognizant of making sure that the benchmark and what we do is pari passu with one another. And in fact, the SLIB and the IFC in our IPS, investment policy statement, specifically state that we cannot move out into these different asset classes. So for instance, any of the funds, the S&P, the aggregate, the bond index, we can only invest in investment grade securities. Now we can tweak between investment grade corporates, mortgages, and treasuries. And so we can do that, but we can't buy high yield. I mean, there's many funds out there that, they can buy whatever they want. And so your index is investment grade and you're buying non-investment grade. We know high yield in the great financial crisis widened out by 17%. So if I invested 10% of the fund in high yield, right now high yield's 200 over treasuries, I would get an additional 20 basis points above the benchmark. That's alpha, that's not beta, or that's beta, not alpha. I mean, that's, you shouldn't be paid for gaming the benchmark. So those are the things that we don't do, and the SLIB tries to make sure that we don't with the IPS that's very restrictive. Now, time to time, just like this Odyssey was brought up, absolutely, we need to correct that. That was something that we missed. But those are, that would be, per the report, the only one that we missed on, and we missed. We should have corrected that and just didn't see it.
You could follow it?
Thank you, Mr. Chairman. I just want to compliment Mr. Fleming and our state treasurer. We've grilled them over the years about taking on this risk and still yet meeting the benchmark. And they've been able to do that, and so I just wanted to compliment them, Mr. Chairman.
Fully agree, and well-deserved compliment there. Well done. Representative Larson.
Thank you. Patrick, if you would, you're in Senator Furphy's conversation on investment grade bonds or something, so can you explain the process if you have a bond or something that's downgraded and it no longer fits in? How then do you handle that? Is there a process?
Yes, Mr. Chairman, Representative Larson. So this happens all the time. You have securities that will fall out of investment grade, the BBB plus and above category. It happens all the time. And so managers, again, they want to be hugging as close to the lower credit as possible without going into that, because you get a higher yield. It's not like high yield where you're 200 over, but you still get higher securities. So many of the managers will hug that, the BBB plus, the cutoff between investment and non-investment grade, because when it drops, then it's non-investment grade. So when they do have a security that drops, they have to call us up per our IPS because they're out of compliance and say, hey, Ford was just downgraded. Our analysts love Ford. It's trading at 175 over. You shouldn't sell this. I'm like, well, thank you for your opinion. Of course you love it or you wouldn't have it in your portfolio, but no, you have to get rid of this. Now, we don't force them to sell immediately because as soon as the security is downgraded, spreads widen out because institutions like us can't own it, right? So everything widens out. But we say within 3 months, if it's close to 3 months, saying by quarter end, you have to get rid of it. But, as soon as possible within a timely frame when, the time goes, but you can, in no instance, can you ever own the security for longer than 3 months. Typically, the quarter end, like if the quarter ends a month and a half, we'll say quarter end. That's kind of the cutoff between a month and a half and less. But at that point, you have to sell the security.
Mr. Chairman.
Treasurer Meyer, welcome.
Thank you. And I think, as you guys can see, in what is, really the last few years, we've been able to, keep a relatively stable, I guess, group of individuals that are very professional and and doing, actually outperforming. We want to make sure that we can continue to do that. And one of the things that we don't have the information on, but WRS does, is called the McLagan Report, and that kind of gives you an idea about whether or not we're, meeting the median. And I would say that after our performance, that we're probably right around the median, but without the performance, we're severely under the median. So those are some things there that I'd like to try to get it in the future that we can index the salary to that McLagan report, so we stay, up to date. So we don't have a time period where for 2 or 3 years we're not able to, recruit, competent people when the time comes. So trying to get something that's a little more indexed with what's going on in the marketplace would, I think, be a benefit in the future. I think we're okay right today, but I think that we're right on the edge of not being okay in some of those areas. So that's something that I'd like you guys to kind of take a look at. One of the things too, we did have a little press about the extraordinary salary levels that we pay in the state. And I would say it's not extraordinary because we're, like I say, we're on the cusp of maybe not paying enough compared to our peers. But I will say this is because of our performance, just in the performance area, that's $600 million, even after we try to implement a succession plan in this session, and you guys will probably see that when it comes through the appropriation process, that we could still pay those wages for 100 years. And think of it, just the outperformance, we could pay the wages of our investment group for 100 years. Now, what we have been leaving behind, guys, is our accounting department. And we've got 2 open positions. One's been open for quite a while. Deputy Williams can go through that at some point in time with you guys, so you got the details on that. But we are beginning to be concerned about unable to actually keep our accounting positions and our accounting team up to full complement. So one of the things that we've been kicking around, and we've been looking at what the WCDA does, and they do have a performance system in the WCDA, and it's not subjective. Most performance systems are a bit subjective from time to time, but we'd like to take a look at that. I think that it would be one of the things that would actually aid in recruiting. And I would think that both the auditor's office and our office would really benefit from just a little bit of the success story that the investment teams have had, and to make sure that we're always got the same complement there. So these guys, when we get opportunities and we want to jump into a different asset class or something, then we've got the horses behind us to actually carry the load. So those are 2 things that I'd say that would look at in the future. May or may not have time to even address those things this year. I know everybody's got a heavy lift coming into this next session. So, but those are things that are on the radar that we need to keep there.
Very good. Thank you for pointing that out. Further questions for the treasurer, Patrick? From the committee? No one online? Sounds great. Patrick, Treasurer Meyer, thank you very much. Thanks for your comments. To our friends at Makita, thank you for your presentation. Well done. We certainly appreciate the work you did on this performance compensation review and audit. With that, we'll move into the RVK portion of the review and audit. We can. We're already behind. We'll wait. You are live. Take it away.
group is quite senior. I have over 40 years in the institutional investment business. My colleague Marcia has, although she's considerably younger than I am, she has quite a few years, almost as many as I do. Samia Khan is very experienced on the client side, was the chief investment officer for a major corporation. And Blake Curtis is an outstanding modeler who joined us and is also experienced. So just wanted to give them a great deal of credit. I am here presenting, but it's really the results of their work. I'm going to work largely on page 6. And I'm going to, because time is short, I know we're behind schedule, I'm going to be very pointed in my comments.
Jim, don't worry about time. You have as much time as as the folks that just presented. So
I
take your time and make
appreciate
sure you cover everything you'd like.
I appreciate that.
We're running on legislative time here, so take the time necessary.
So we're on Wyoming time. I like that. Yeah, I'm used to working on New York time. That's not so great, even though I live in Oregon. Page 6 has a lot of information on it, and it really is a true executive summary, so I want to spend some time on it. The first thing I want to say is we'll talk a little bit about benchmarks, but the key point that I want to get across here, which is number 1, is that the purpose of a benchmark is to understand the performance, the behavior of the fund, the portfolio, and try to anticipate what its performance might be going forward. It is an ancillary connection to a performance compensation plan. By that, we mean if for any reason you think that there's something that needs to be addressed in the compensation plan, it is highly unlikely, if there is a good benchmark process and the use of benchmarks is institutional quality, that the solution to your concerns lies in benchmarks. It lies almost certainly in the construction of the PCP itself. And we're not saying there is a problem, but we're saying don't confuse the two as to which is primary. If your concern is about the PCP, focus on the structure of the PCP. Make sure that the benchmarks are appropriate, but once that's done, those benchmarks serve a purpose that goes far beyond the PCP. So that's the point I wanted to make on number 1. Number 2 is we were asked to comment on governance as it applied to this particular project. And so we interviewed an enormous number of people. I lost track, dozens. And one of the things that came out that's quite clear is that the benchmarks that the WRS board has approved are the fruit of really a multi-party process for benchmark setting and review. And interestingly enough, there's a 5th one now on the table, which is RVK itself and this report. And so we've got 5 parties involved in looking at these benchmarks, and only one of them has financial, i.e. compensation, skin in the game, and that's the staff itself. So we're talking about a governance process that looks at benchmarks, and there are now 5 players involved, and only one of them is a participant in the PCP. So that should give you some, at least some governance conviction that there are lots of people looking at the WRS benchmarks that have no involvement in the PCP and no incentive to do anything other that's in the best interest of the fund. And we're one of them. I'm going to address items 3, 4, 5, and 6 together because they really are, and I was saying to Sam, the CIO of the WRS, that the legislature did the board and the staff and the executive director a favor here by actually requiring the execution of a very detailed benchmark study. And if you look at our report, you'll see the level of granularity is excruciatingly painful, down to nickels and dimes. And so what I would say is that we have found a number of tweaks that we would recommend that the board consider. If we were the GC, we would be recommending them. But what's interesting here is that these benchmarks, whether the tweaks that we recommend are the ones that are in use, are all widely used by institutional investors. There are no benchmarks being used by the WRS that you say, well, where did that come from? They are observable in lots of institutional funds with and without incentive compensation plans. We've also concluded that none of these, if they were to adopt all of our tweaks and recommendations on these, and they are listed in both this presentation and the report, none of them really are material to the total fund return. They simply improve the quality of the benchmarking in terms of accuracy and focus. I suspect that the WRS board will take a look at our report and they'll decide whether or not, in their best judgment as fiduciaries, whether any of these tweaks should be part that come out of this benchmark study, should be adopted by the board. When you see differences between consultants and staffs or whatnot about one institutional quality benchmark versus another, I would not jump to the conclusion that one is defunct or bad or obsolete or is the result of gamesmanship. It's more like, if I could use a metaphor, and some of you may be attorneys, I'm not, but unfortunately, after 45 years in business, you can't help but be involved in attorneys in one way or another. It's kind of like attorneys arguing over which is the best case citation to make in a pleading to a judge for a motion. Two different law firms may say, no, this is the one that's most on point. The other one may say, no, this one. Benchmark divisions within institutionally recognized and quality benchmarks are very much like that. They're also like engineers arguing over whether or not a cantilever bridge would be better in this particular site versus, say, a suspension bridge. Both of them are well-researched, well-engineered types of bridges, but engineers may differ as to which one would be most applicable in those situations. So we do have a set of recommendations, and WRS, I think, is the beneficiary of what I believe, is an extraordinarily detailed benchmark study that came out of this required exercise by the legislature. And so we would also say that one of the things that gives us more confirmation about our conclusion that these tweaks would not have affected the outcomes of the materially the total fund or the incentive compensation plan is that WRS has adopted a total fund approach. You heard our colleagues mention that this is something that incentive compensation plans are moving toward. And WRS board, in their implementation of the authority that you gave them for the PCP, has decided to use total fund returns. That means that it takes a lot, I mean enormous amounts of manipulation underneath to change the total fund return in some material way. But that changes if you move down to the asset class level. So I think that in the case of the state fund, which I don't work on that particular RVK team, their implementation of your plan is definitely more complicated and requires a few more considerations than the WRS plan, which is a cohesive plan that is consolidated, and you're essentially rewarding the team and only the team, and those decisions about who on the team should benefit are really managed after that process, but don't affect the amount of incentive compensation available. If I could move on to page 8, I'm sorry, not page 8, but number 8 on page 6. There's a question about that always occurs about exposures held outside the benchmark or the use of leverage on a particular investment or an asset class. One of the things I would say is that, first of all, recognize that when
This is a very common practice. It is almost always, in fact, I think it's pretty much always limited by the IPS to very specific amounts, and those limits are translated down into what are called the IMAs, the agreements with the managers which they must abide by. But the more important thing is that it is assumed that if you have 5% of your portfolio of a particular asset class or a mandate outside the benchmark universe, that it's always going to be positive. That is not the case. It is a risk. It is a risk and one that institutional investors take all the time, but it doesn't necessarily mean that it's going to have a better outcome. It could hurt you. The same thing is true with using leverage or overlays. So from the perspective, and I'm a former trustee on both public plans, multiple public plans, and multiple corporate plans, one of the things that you want in these particular situations is to have in the IPS a very clear understanding of what is and is not permitted, which we found with one exception involving CLOs at the WRS. But we found something that was even better. I think in terms of transparency and the ability of the fiduciaries to understand whether they were being helped or hurt by any of these small diversions to exposures that are not explicitly in the benchmark. And that is that they have contracted with Russell, very well-known, quantitatively oriented consulting firm, to do a regular report that does not look at the benchmarks and themselves, but instead looks at the total portfolio, and regardless of where exposures lie, they are rolled up into a single report so that the fiduciary board can look at it and say, at the total fund level, where the incentive compensation plan is, which drives the incentive compensation plan, are we doing anything that is unusual or strange in terms of our equity exposure, our fixed income exposure, our real estate exposure? And that report is done on a very frequent basis. I have to tip my hat to the WRS board and staff for executing this report, because I think it goes one step further than we typically see in institutional plan sponsor funds. As I said before, point 9 I started off with because I think it was so important, and that was that changing benchmarks may or may not help if they're driven by concerns that you may have on the incentive compensation plan. But what you risk if you think that the answer lies in benchmarks is that you may make it more difficult for them to perform their primary role, which is to inform the fiduciaries and the constituencies, other interested parties, including the legislature for sure, how the performance of the portfolio is going in multiple directions, in multiple aspects. And we'll talk a little bit about risk in a moment. So, you know, in your scope of work that LSO delivered to us, one of the things was, you know, do you think that there are any opportunities or should there be considerations for looking at improvements in the incentive compensation plan? And we think the answer is yes, but we don't think they lie in benchmarks. They lie in plan construction. So I just want to emphasize that one more. The other thing I would say is that in that same respect, and this is point number 10, I've worked on, and my team has worked on a number of different situations involving incentive compensation. And I've seen many of them, and I spent the good part of 20 years on Wall Street that was loaded with incentive compensation plans. There is no consensus about what the optimal structure for a performance compensation program is. In fact, you heard our colleagues say, well, why is it now 3 years? Maybe it could be 5 years. Already question on the table. So there are objectives that you should look at, and I believe you did do that when you constructed the program. We did some research into the initial creation of the program about trying to emphasize the objectives that you wanted, which is recruitment and retention of quality investment professionals because they're so important to this state. That when you look at any changes you might want to make, you should go back to those same objectives unless you have new ones. And I'm not aware that anybody in the many, many interviews we did have any new objectives. And in fact, I will say to the point of number 12, that almost, in fact, to a person, the individuals that we interviewed at all levels, from the very highest level in government to staff, to trustees, to trustees and advisors and staff of other outside of WRS, there is a clear belief that the program that you authorized that has been implemented at the two plans, including WRS, which is our bailiwick in this project, has actually had a very positive effect. I'm terribly aware, having worked in the public sector in both the federal and the state level, that compensation is a sensitive issue, without a doubt. And but so is underperformance and having poor professional capabilities in places where they can do harm to the interests of the state. So I think that, and on the contrary, as you heard from Patrick, when you get quality individuals and they are able to produce good things for the state, it benefits everybody. So it was interesting to us that the legislature asked us to look at this program. And yet, when we interviewed these, several dozen people, what we found was that to date, they believe that the program has had a very positive effect. There were some other recommendations in terms of structure. One of them is point 13 on page 6, and that is there was some thought to why not expand this program beyond the senior investment staff. But that was a clear minority, but we did encounter it, so we wanted to report it. And while there is no consensus regarding the optimal incentive compensation program, I will end with a couple of thoughts that might lead you or that might be useful to you should you desire to actually look at considerations for possible changes in the structure of the PCP plan. So that's the executive summary. If it's okay with you, Mr. Chair, and you are still being generous with time, I will dance through a couple of pages here where I think that there are some points that relate to this overview. I'll stop for questions as well, and then I'll end with the comments that I just made about the structure of the program.
Questions based on what he's presented so far, committee? Okay, seeing none, I think your approach sounds great, so please proceed, Jim.
Okay, we're going to put Karen to work here because we're going to dance a little bit. I'm going to go quickly through this because our colleagues also touched on this, but page 8, if we could move to page 8. Benchmarks are really important. Fiduciaries, particularly for fiduciaries, having been one on multiple plans, I appreciate their role, and I do as well now serving fiduciaries as a senior investment consultant. But it is, as I said, the governance process that produces benchmarks for WRS is broad, and it is almost entirely, with the exception of the staff, without skin in the PCP game. The other thing is that what we found with very few exceptions, in fact, only one exception, the benchmarks are in compliance with the guidance provided in the IPS. And we think that that's important because the one party that does have an incentive, if one was concerned about it, to either take more risk in the pursuit of returns and therefore compensation, or otherwise try to structure the benchmarks to assist in that process. The IPS is the board's document, and presumably also advised by their independent consultant advisor as well. As I won't spend too much time on page 9, I'll just use another metaphor because this has been
Interrupt you there.
covered.
We have a question. Representative Larson?
So I'd like to, thank you, Mr. Chairman. I'd like to go back to that, the statements you were just making on the IPS and the investment within that and it being the board's document. And so based on what we were hearing in the previous presentation, it sounds like that IPS is really is a governing document and sets or outlines what investments can be used in the benchmark. And if I'm understanding that accurately, I want to understand that then you feel that within the WRS, they too are complying with what the IPS strategy is and are not using investments outside that IPS to be considered as part of the benchmark.
We believe so. Now, a good investment policy should do exactly the things that you say, and we believe the WRS has a good one. It's not that we don't have recommendations that you'll see, for example, there are examples on page 11, 12, 13, 14. These are of the nature of, we think there are other institutional quality benchmarks that the board should consider that would be helpful in both the primary role of benchmarks, which is to understand the performance of the portfolio and its risk and return capabilities, but also indirectly for the incentive compensation plan. I think the one exception we found was CLOs, if I recall correctly, that we would recommend that CLOs be be included in that list of investments that the investment policy statement explicitly instructs the staff that they can use.
Mr. Chairman, a couple of follow-ups, but could you help me with the CLO thing?
Oh, I'm sorry. I
and-
fell into jargon and I try so
Yeah,
hard
I
not to
know.
do that.
Well,
I'm so
I'm from
sorry,
Landers, so-
Representative. Collateralized loan obligations. It's a type of structured fixed income investment where a bunch of loans are packaged in a single unit and then bought and sold. So it's not a majority of their fixed income exposure. I
But it
believe-
is, Mr. Chairman, but it is outside the IPS is that the message you're sending and it would be a recommendation?
Yes, and I believe we're recommending that the board put it in. It is not an exposure that we typically don't find in institutional portfolios. Very common, very well understood, just happens not to have been listed in the portfolio, or in the IPS. Sam, did I get that right? There you go. I got it right. And my team was, I think, my team was hoping that I wasn't going to be too far over my ski tips. And again, I apologize for the acronyms.
So then a follow-up, if I may. And so you talk about the board, and again, I'm trying to put the two presentations together and trying to identify the likes and the differences between the structure and the governance of the State Treasurer's Office and the retirement system. And so as we look at the retirement system having a board versus the State Treasurer's Office having an investment funds committee, is there a difference in the expertise that may come with the WRS's board making recommendations versus the structure?
Well, Representative, let me try to unpack your question. One is, are there differences between the two funds? Tremendous differences. In fact, it's not a good idea, we think, given the mandate that the Treasurer's Office has with multiple funds and also, I believe, constitutional requirements as to that, and the SLIB was referenced, that restrict their investment range of investment freedom, so to speak, to some extent. Plus, those are the state assets, whereas the WRS has assets that are actually in trust for participants, and they do have a fiduciary board. And, that fiduciary board certainly is subject to statute, but it's not subject to ERISA. So the differences are significant, and the differences in the way they have implemented the incentive compensation program are different. I'm not saying one is better than the other. They pursue different goals. And as I said before, the total fund one is more like rewarding the team, more like what I believe half of the incentive compensation implementation for this treasurer's office does. It's the entirety for WRS. But going back to your point about your last point, should the board have enough expertise on the board to make good judgments about what should be in the IPS? Well, the answer is yes, but it is a kind of a standard fiduciary practice that if a board feels that it doesn't have enough expertise to make good judgments, they are obligated almost to go find experts that will assist them in doing so, which is why it's almost universal that the general consultant does not report to the staff, reports to the board. They may collaborate with the staff, but they are the board's consultant. And this is true for legal matters and all kinds of matters where there may not be resident expertise on the board. Is that helpful to your question? Okay.
Further questions? Not seeing any. Please proceed.
Okay, I'm still on page 9, but I'm moving quickly here. Our colleagues talked a little bit about the requirements for a strong benchmark. These are the ideal requirements, and I use the example, and you probably all have had your IT folks say, use strong passwords for your security. Don't use weak passwords. Well, the CFA, which is not a regulatory body, but it is a very influential body in institutional investing, has come up with a list that you see on page 9 of what would be considered a strong benchmark. But if you look on page 10, what you'll find is the reality of the world is that not every asset class can meet every one of the requirements for a super strong benchmark. So if you just scan, and I'm not going to go through these because it would be painful for all of us, but just look at those red X's that you see on page 10. Those are areas where a particular type of investment or asset class can't meet all of the requirements of a strong benchmark. They simply can't by their very nature. And so those are the areas where folks like our colleagues at Makita and ourselves will sometimes differ as to, like, well, what's the best benchmark? And in fact, what you'll see is, let's look at private equity, for example. You notice that there are 2 red X's in that line. It is a notoriously difficult asset class to benchmark. If you turn to page 14, you'll see that private equity has a current benchmark on page 14. It's the last panel down, and it is a very well-known one. It doesn't meet all the requirements of a super strong chartered financial analyst required benchmark. And we suggest that there is another one that we think is at the very least complementary. In fact, we almost recommend that these both be used at the same time, that you see on the right side of that panel. And I'm sure our colleagues are very familiar with it. So that's an example. And by the way, our recommended benchmark also does not meet every single one of the super strong requirements for a CFA benchmark, because we don't have one in reality in the real world that exists. That's why we tend to use both of these simultaneously. So that's just an example that I'm giving you about not to be alarmed over differences of view as to this benchmark or that benchmark, so long as they are within the suite of benchmarks that are institutionally used, recognized, and reflective of what the actual investments are. So I'll stop there on that topic. Page 18 relates to, if we could move to that page, a recommendation that actually ties to the question that was raised about 5 years, and a concern that we have about the structure of the PCP. And that is that the current incentive compensation plan uses an arithmetic average of the last 3 years. That is, just add up 3 numbers and divide them by 3. Nothing terribly wrong with that except for one thing. In the world of investments, we typically go to a higher standard, and that is compound returns, where we actually look at the geometric calculation. And the reason that we put this in as something that you and the WRS board should think about is that the geometric calculation, it has embedded in it not just the returns that were achieved, but also the risk of the path of those returns. And so we like that better. It's what we use as a standard in our asset liability studies, our asset allocation studies. And so it's something to consider. And what's interesting about the connection to the 5 years is that the longer the period of time that you have, that is relevant to the current team that you have in place at WRS and the board itself, the more the geometric calculation will actually help you understand not just the returns, but at least one type of risk that was taken during the path of those returns, during the period under examination, because that's included in the compound calculation of the return. I don't want to get into the math of it, but there's, on page 19, we ran, what I think, 10,000 trials in a very sophisticated, what we call stochastic analysis, and asked the question, is it ever possible that you could have a positive arithmetic excess return, but a negative compound excess return? And the answer is exceedingly rare, but at least it's statistically possible. And what that means is that it adds a little bit more weight to our recommendation that this should be considered. I think in particular, this recommendation, the WRS board should give it some thought, because the IPS itself does not have a risk budget in it. Now, when somebody hears risk budget, they say, oh, that must be a good thing. Well, not necessarily, but its absence means that there's not a clear connection between the structure of the incentive comp program and risk taken other than the achievement of the returns themselves, but not the path of returns. And so this smoothing that you heard Patrick talk about, we think it should be calculated on a compounding basis, not on a simple arithmetic basis. And that will essentially negate any recommendation that we might have for a risk budget. And we don't like, risk budgets can be dangerous because it's almost like putting a minimum requirement on your investment staff, and you don't, before they do their work, and you don't understand what its consequences might be. We actually believe much more profoundly in following the tracking error, which is a risk measure, the vol, which is a risk measure, on a very frequent and highly transparent basis to make sure that excessive risk is not being taken, whether it's just in the nature of the enthusiasm over the investment process, or whether it's in the hopes of having higher incentive compensation. Let's see. The other anomaly that we found in the structure And maybe it's not an anomaly. Maybe it's something that you thought about as a legislature and you wanted in place. Is discussed on page 21. It's a little complicated, but let me tell you what the bottom line is, and that is that if WRS were to feel, and the WRS board were to feel the need to add 2 more senior professionals, the consequence of that would be that the amount of excess return that would have to be earned would go up. Now, on the one hand, you might say, well, if they're going to have more investment professionals, we should have a higher expectation of even more excess return from the assets. Well, maybe. Maybe those investment professionals are there to defend the fund as opposed to trying to add even more returns, or they're required by statutory requirements, compliance requirements. I mean, there's any number of things, complications. The investment universe may become much more complicated. So to even earn any excess return, one might need to put more investment capability, capacity in place. But the net result of that would be they would have to have more dollar-weighted excess returns in order to achieve the full benefit of the incentive compensation program. Like I said, that may be something that the legislature thought about at the time it was created, but we think it's something that should be revisited because we think that the compensation program is not the best way to control the budget that the investment budget for the WRS. That's better controlled on a direct basis, we think, as opposed to indirectly through the incentive compensation plan. Let's see, what else do we have here? I do want to be sensitive, despite the generosity of the chair. I do want to be sensitive. One of the things that is in debate all the time in incentive compensation programs is the mix of salary and incentive compensation. So I come from a long time in Wall Street, and we, in investment banking in particular, sometimes 80 to 90% of a managing director's compensation could come from incentive compensation. You have to want to incentivize an individual an awful lot to do that, and there's always a trade-off, because if there is a dry year in the managing director's area, because they typically have turf, for example, I use this as an example, then all of a sudden their compensation plunges. And that's not good for retention. It's not necessarily good for the long-term capability of the investment staff that the state, by the very creation of this program, wants to have. But there is no analytic way to say, gee, is 50-50 right? Should it be 60-40? Should it be 70-30? So far, it has, by all accounts, aided in recruitment and helped retention, reduced turnover. But one always rolls the dice a bit when it comes to having an awful lot of an individual's compensation based in incentive comp, which could change significantly from year to year. We don't have an answer for that, but if the program is reviewed, that should be on the table, along with 5-year, along with compounding, and along with a few of the other less important recommendations that we have here. So I will stop here, and I will answer questions. I have gone on now for about 45 minutes, so I want to make sure that that you have a chance to grill me. I'm used to it.
Representative Larson.
Thank you, Mr. Chairman. I have 2 questions, if I may. My first one is similar to what I asked of Makita on the Treasurer's Office, and that was on transparency. Do we see a similar, you noted that a little bit, but can the can the public, can the retirees go into their website and find these quarterly and annual reports that we would hope would be available?
I think the answer, Representative Chair, is yes. I know our first conversation was with the kickoff conversation with the CIO and the executive director to request information. And I would say that probably 80% of our, we would like to see this, we would like to see that, was it's on our website. It's on our website. It's on our website. So I think the answer is yes. To be certain, I'd have to be part of the WRS team and watching every single day, but I have no indication that there's not a substantial amount of transparency.
Thank you. And then, Mr. Chairman, I apologize for this next question. As you know, I often ask questions that make no sense to the rest of the world, but I'm trying to get my head and connect the dots a little bit in this conversation on the importance of the investment policy statement and how that ties to the compensation plan in paying the alpha and not the beta. So maybe I can come back to, was it CLO? Was that the term we used? So if you got an asset allocation, maybe like with this CLO, and a percentage of that went outside the IPS. So in this case, what percent of that asset allocation was to CLOs outside the IPS? And would that influence does the percentage of what you're investing outside the IPS then influence how acceptable that may be?
The answer is, Representative and Chair, if it were really substantial and big enough to move to essentially make the total fund returns different than the policy benchmark, because that would not be in the policy benchmark, then the answer would be yes. That doesn't appear to be the case here. And by the way, I would point out again that it doesn't necessarily help returns. It only helps returns if it's a wise investment. It could harm returns. So there's no guarantee that it will help create more opportunity for incentive compensation. It could, in fact, put a ding in it. But still, from the perspective of the primary role of benchmarks, which I talked about at the beginning and in the middle of my statement, from the board's perspective, we think the board should want to make sure that there is complete alignment with what, even if it's only one of many sub-asset classes that's not in the IPS that is routinely used, it should be in the IPS, or the board should say we don't want it used. Make a judgment one way or the other.
Further comments from the committee? Looking at our online friends, not seeing any online. With that, I do the same that we did for the Treasurer's Office and ask Mr. Swindell and Sam, Mr. Masudi, the CIO, to come forward and just offer your thoughts on the recommendations that were provided in this report and ways you may address those going forward. Jim, thank you very much for all that you provided to us. That was an excellent audit, excellent report. Thank you. And stay seated, as this might be a little back and forth. So, Sam, are you starting us off as the CIO and the one directly impacted by performance comp and as such? So, what are your thoughts on the suggested recommendations to move forward and slight tweaks to the plan?
Yeah, sure.
Or
Thank you,
benchmarks,
Mr. Chairman. Yeah, overall, I'd like to thank RVK first for being extremely thorough. We provided a lot of information, as did Makita, and they were very thorough and asked a lot of great questions, and were always a pleasure to work with. So we appreciate the report. Overall, the performance compensation plan has been keystone of our success. We had a lot of turnover prior to this because our compensation wasn't competitive. And since this program's been in place, we've only had one departure of a junior person. So besides that, no departures in 5 years. We're very grateful to all of you for helping putting this in place. As I think Makita and RVK have mentioned, benchmark, and there's a little bit of art to it, and reasonable people can come to different conclusions. I think with the suggestions that RVK has made, they're all very reasonable. I think that from an investment team standpoint, we can support that. I can't speak for the board, but I think it's likely that they will accept most of these suggestions, and I don't think they would result in necessarily different benchmark returns, higher and lower, who knows? But I think that they'll improve transparency and they'll be easier to understand, which I think will give all stakeholders more confidence in the program. So yeah, I'm certainly supportive.
Mr. Chairman, I'll make a few comments. I'm David Swindell, the Executive Director of the Wyoming Retirement System, and I also concur. Thank you, RVK, for their report. It's very detailed, pretty heavy for 8 o'clock in the morning, but there you go.
I didn't schedule the 8 o'clock.
There you go. I want to remind the committee of just a couple of comments that are right out of the report because we kind of got into some detail, but I go back to the executive summary of the report. Overall, number 11, the board's implementation of the legislation that incepted the performance compensation program is thoughtful and aligned with the decision-making process at WRS. The many professionals that RVK interviewed touching aspects of the performance compensation program share a consensus view that it has to date met its objectives. Those are two big concerns that I think the legislature should have. The incentive comp program has been a key component of stability on the investment team, and that has resulted in superior investment returns. I remind the legislature that it wasn't always so. Mr. Chairman, I would go back to 2007, take us back 17 years. There was a report from there was a management council audit of the retirement system in 2007. Polly Scott, I think you worked on that report. It's among other things, that report said, hey, maybe it's time for the retirement system to have a professional investment operation. Because at the time, the board was simply selecting amongst bond and stock managers that would appear before the board. They were managing 14 different managers. There was no investment professionals on the staff. In 2009, the position of Chief Investment Officer, Sam's role, was first appears on the organizational chart at WRS. And in the meantime, we had encountered the 2008 recession. The Wyoming it was a bad year in the investment markets. The median public fund went down 26%, but Wyoming's fund went down 30%. And we didn't recover as fast as others. 2011, another messy investment year. The typical fund only gained 1.5%. We lost 1%, another 2.5% delta. Millions and millions of dollars of lost opportunity. Sam's been with us since 2013, 11 years of service. Thanks, Sam. Over time, with the help of the legislature, we finally got to resource the team. Resourcing the team means positions and compensation. It was in 2016 we finally fleshed out most of what we have today with the number of positions that we have. And in recent times, in the last budget, we added 2 non-investment professionals, but the first middle and back office staff that the team has had. That's important to keep the professionals focused on investing. The results have been outstanding. The incentive comp report that we just submitted to you notes that since inception of the program 5 years ago, we've beat the benchmark with a value add of like $624 million. It's huge. 2/3 of a pension is paid for with investment earnings, not with contributions from either the employer or the employee. We paid out $800 million last year. 79% of it went to Wyoming zip codes at $624 million, and it went to your constituents. To keep that money flowing, that's the purpose of the pension plan, and having an effective investment operation is key to that. One final thing I might point out, there was some talk about the board's expertise and how the board is instructed. I would remind the legislature that the Wyoming Retirement Board is a little different than the Investment Funds Committee in terms of its authority and responsibility. Statute places on the board the responsibility to manage the entire operation of the Wyoming retirement system, and they have commensurate authority. They hire me and they can fire me. So it's a different sort of relationship. They have the authority to make changes if they need to, just so you know. With that, Sam and I will both stand for questions from the committee, and we thank you for your time this morning.
Sam, I'll ask the same question I asked Mr. Fleming earlier. Would you have positioned your investments any differently had performance compensation not been in play?
We would not have. I think that performance compensation probably focuses the mind a little bit, and I think we would have had significantly higher turnover, so that would have been the biggest impact. But in terms of implementation, probably not significantly.
Mr. Chairman, I think we would just submit you the quarterly investment committee report that the board receives. It has all that detail in it.
Very good. Thank you. Representative Larson.
Mr. Chairman, as we wind this up, I'd just like to thank RVK for being here in person. It just it's so much different having you sit here where we can hear you and see and talk to you versus online. So just for me personally, thank you. And thanks. You're emeritus now. Thank you for your good work.
Senator Guru, I see you've got your hand up.
Thank you, Mr. Chairman. I wanted to just first thank RVK and thank Sam and Dave for their presentation. I do have a question, and I know there are differences between the two, between the STO and retirement. But one of the things that was brought up in the RVK report about data, and I was trying to fumble around your website to look, and I just couldn't see it. So I was just saying, where could I access return data on your website? It was talked about. And then also just talk to you about, I look forward to hearing what the board has to say about the recommendations at RVK. But Dave or Sam, either one, just highlight that too about what you see, if you see any obstacles to those recommendations.
Mr. Chairman, Senator Guru, I don't see any obstacles. The board will consider some of the aspects on the benchmarks in due time and with good consideration. The biggest public report that's on the WRS websites are annual financial reports, a big thick thing. It has an entire investment section, and it covers the asset position at the end of the fiscal year in considerable detail. We don't publish all the board packets on the public website it attracts some attention from investment professionals that want a lot of public information on it, but we can. They're certainly public, and we make them available to anybody who asks.
Very good. Representative Knapp, I see your microphone's turned off and as though you're ready to speak. Do you have a question? Okay, sounds good. Our LSO staff, if we wanted to require WRS to do a quarterly and an annual report, much like the STO does, do we make that via a bill, or do we just make that via a request here today?
Mr. Chairman, you could do that either way, although I think more commonly it would be done in statute.
Okay.
But certainly, I mean, if this committee requests that of the agency, they can comply with that. We typically put those in a statute, of course, and that requires the action of the entire legislature.
Very good. Committee, would you be agreeable to have them report that much like the STO on a quarterly and an annual basis?
Yes.
Senator Hicks?
Yeah, Mr. Chairman, I'm just I think it's probably a good idea, but I'd like to hear from WRS as to what additional cost and labor that would be associated with doing that.
Mr. Swindell?
Mr. Chairman, Senator Hicks, of course, we already, publish our annual financial report, and that is required to be submitted to the legislature, as well as our actuarial report. So we do that annually. To do quarterly, we do quarterly analysis. It's reported to the board, and we can certainly share that with the legislature. There wouldn't be a lot of cost, just time and energy.
Yeah, so, Mr. Chairman, I don't know that we need to legislate it. I think if this is the direction we wanted to go, we just would request that WRS provide that. So that's my thoughts.
I would concur, so I think that would be the recommendation of the committee, is we would ask that the WRS provide the same quarterly report to the legislature that they report to their board, as well as the same year-end report they have for their board to the legislature as well.
Mr.
Hopefully
Chairman,
not
would you like
increasing any
that to this
workload.
committee, to the Joint Appropriation Committee?
Both.
Everybody on the legislature?
To both. It would
both
be to
committees?
CAPFIN as well as JAC. And then the remainder of the legislature can get it through those two the portals of those two committees.
Mr. Chairman, while I've got the microphone on, I do want to thank RVK for one more thing I should have mentioned. WRS has a separate relationship with RVK. It's a completely different component of Jim's company, but Bo Burgraff and Eric Painting of RVK are the board's consultants on the 457 Deferred Compensation Program. That's a $1 billion operation that allows employees to save for retirement, to supplement their pension, and they do a great job, so I thought I ought to mention that. Thank you.
Very good. Any further questions for WRS or for RVK in their presentation on performance compensation? All right, seeing none, again, thank you very much for being here. Mr. Swindell, Mr. Masudi, thank you for answering the questions. And Jim, thank you for being here in person. I completely concur with Representative Larson. It's great having you in person.
It's a pleasure. It's a pleasure. Thank you for having me.
Wyoming is a great place to be. Okay, committee, we are going to take a leg stretching break for about the next 10 minutes. When we return, we'll be discussing the LSO 125 and LSO 126 local government investing. So about a 10-minute break. See you at 10:40. Okay, if we could find our seats, we'll try and get rolling again. I did, thank you. Thank you very much. All right, I think we're ready to get back rolling. And we will start this presentation with 25 LSO 125, followed by 25 LSO 126. And this is local government investing. And Mr. Fuller, if you would present the bills, and then we'll work them separately, but we'll present them both while you're at the podium, please.
Okay. Mr. Chairman, you should have draft 0.6. This is 4-01 in the online meeting materials for 25 LSO 125. This is the bill draft that would authorize local governments to invest directly in stocks and equities under conditions that are specified in the bill draft. This draft reflects the changes that the Select Committee directed from its September meeting. Namely, those changes were to limit this opportunity only to cities, counties, and towns, specify that up to 30% of that local government's reserves may be invested in stocks and equities under this bill draft, and then also removed certain requirements, including the requirement that each local government that does this create a separate local investment advisory committee. So that's been removed from this version of the draft. So the staff comment, pages 1 and 2, just note that under Article 16, Section 6A 2C, this bill would require a 2/3 vote of each house for enactment. Moving on to page 3, the top of page 3 is, we're down to one definition now, local government defined to mean county, city, and town. Page 3, line 8, authorizes a local government to invest any funds that are specified in subsection B below in equities, including stocks, in accordance with all of the following provisions. So first, page 3, line 13, any investments that are made must be made with a person who has not less than 10 years of investment experience in the management of a portfolio that exceeds $110 million. Then second, a broad understanding of financial markets. And then moving on to page 4, no felony conviction or disciplinary action involving moral turpitude, and no conflicts of interest that would lead to a violation of various provisions of law concerning public officials and conflicts and ethical requirements. The staff comment on page 4 just notes the 2 qualification requirements that the Select Committee removed in September. And the first would be a requirement to be registered under the Federal Investment Advisors Act. And second, the requirement to have and maintain at least one physical office in Wyoming. The staff comment at the top of page 5 is another requirement that was removed that specified that each investment made in stocks and equities be held for at least 5 years. That was removed from this version of the bill draft, but is left in as a staff comment for discussion per the committee's direction in September. Then page 5, line 16, funds invested can't exceed the amount specified in subsection B. Line 20, the local government must specify as appropriate the disposition of earnings from investments that are made under this section. Then page 5, line 26, the amount and type of monies that are invested by any local government must be in accordance with the following. So on page 6, the amount of monies invested under this section can't exceed 30% of the local government's reserves that are available for investment. And the 30% figure was a figure directed by the Select Committee in September. Then page 6, line 7 just specifies that for purposes of this 30% calculation, any earnings made from the investments in stocks and equities do not count toward that limit, and those can be reinvested in stocks and equities. Page 6, line 13, this is basically the Meyer rule provided for local governments. So it specifies the disposition and crediting of earnings, requiring those to be credited by the end of the second month following each fiscal quarter. Other realized earnings credited as soon as practicable, but not later than 90 days after the fiscal year. And then any debit against the account that exists as a result of realized investment losses must be paid before distributions are made. And then page 7, line 11, the local government may credit any earnings at earlier times and in such amounts as may be advantageous for that local government. And then this would be effective July 1, 2025.
Very good. All those in favor? Just kidding. With that, any comments from the committee on either bill?
That was this first one.
That'll work. Okay,
Okay. Would you like me to proceed with 126, Mr. Chairman?
Sure.
Okay. So 25.
got ahead of myself.
Yeah. So Mr. Chairman, members of the Select Committee, 25 LSO 126, this is draft 0.7, local government funds pooled equity investments, 4-02 in the online meeting materials. This is a bill draft that would authorize local governments to form a pool for purposes of investing local government funds in stocks and equities. The structure of this draft is loosely based on the local government liability pool program. The staff comment on page 2, once again, this draft under Article 16, Section 6A2C would require a 2/3 vote of each house for enactment. Page 3, line 8, the definitions in this draft include a definition of board. This draft, unlike the first one, does retain the concept that this pool would have an investment advisory committee similar to the Investment Funds Committee for the investment of state funds. Similar to the previous draft, on page 3, line 15, local government is limited to county, city, and town. Then page 4, line 1, this is a section that creates the local government equity investment pool program to provide a mechanism for local governments to pool funds for investment in equities. There's an intent statement that the local government equity investment pool be operated by a joint powers board formed by participating local governments. That language is very similar to current law for the local government liability pool program in 142-202A. Page 4, line 13, provides that the board consists of a number of members as determined by the participating local governments, and board members would serve terms as determined by those participants, and the board must include members from the different types of participating local governments. All of that, though, would be left to the joint powers agreement that the participants would enter into to form this pool program. Page 4, line 21, provides that the participating local governments may provide salary, per diem, and mileage to board members and members of the Investment Advisory Committee for expenses incurred in the performance of their duties in the amounts not to exceed those that are provided to legislators under 28.5.101. Page 5, line 4, provides the duties for the board. So the board must administer the pool, consult with and receive advice from the Investment Advisory Committee, establish assessments and fees for participating local governments to operate the pool, which may be calculated as a percentage of earnings from the pool and may be assessed from the pool's earnings as the board determines. Then on line 18, the board is required to apportion and collect assessments from each participating local government. Those assessments can only be used for administrative expenses and fees for investments. Then on page 6, line 2, the board would be required to adopt rules governing the administration of the pool. Then page 6, line 5 provides board duties for which they must consult with the Investment Advisory Committee that's established under this bill draft. So first, that board must establish procedures for the investment of the participating government funds in the appropriate investment assets and classes. These investments must provide that they be made with a person who has, and again, similar to the last draft, at least 10 years of investment experience involved in managing a portfolio in excess of $110 million, a broad understanding of financial markets. Then on the top of page 7, no felony conviction or disciplinary action involving moral turpitude, and no conflicts of interest. Similar, the staff comment on page 7 notes that the 2 requirements for registration under the Federal Investment Advisors Act and a physical location in Wyoming, those requirements were removed. Same with page 8, similar to the last draft. The provision requiring investments be made for at least 5 years was removed, but kept in a staff comment per the Select Committee's direction for perhaps further discussion. Then page 8, line 19, limits the amount of funds that can be invested. The procedures that are adopted must also provide for the monitoring, controlling, depositing, and retaining of investments, procedures for agreements to be made between the pool and a person to invest the funds. Then the top of page 9 would require the board to adopt procedures for implementing investment policy statements for the pool's investments and for ensuring that investments are made to strive for the highest possible risk-adjusted total net return, consistent with an appropriate level of safety and liquidity. And then finally, procedures for standards for competitive bidding to be used to select a person or persons to invest the pool's funds. Page 9, line 13, would require the board to establish a process by which participating local governments enter into an agreement with the board for the investment of funds in the pool, including requirements for how the funds may be deposited or transferred to the pool, how funds may be withdrawn from the pool, including limitations on the withdrawal and penalties to be imposed for the early withdrawal of funds from the pool. And then finally, an agreement for ensuring that funds that are provided by participating local governments may be invested to meet the investment objectives. Next, page 10, line 8 would require procedures for the calculation and disposition of earnings, including how earnings would be apportioned to each participating local government. Page 10, line 15 would require and limit each local government participating in the pool can only provide funds to the pool in an amount that doesn't exceed 30% of the total amount of each participating local government's reserves. And then second, similar to the previous draft, earnings would not count in that 30% calculation. Page 11, line 7 provides that the board may deny a local government participation or can terminate a local government's participation for a failure to pay assessments or for the early withdrawal of funds from the pool. Then similar, page 11, line 16 is basically the Meyer rule for this pool, and that continues through page 12. Then page 13, the staff comment. This is the language, the section in the bill draft that establishes the Investment Advisory Committee for the pool, and most of the provisions from in this section are modeled after the Investment Funds Committee in current statute. So page 13, line 11, creates the Investment Advisory Committee for this local government pool. The committee would consist of 7 voting members who are appointed by the board in accordance with this section. The 7 voting members serve a 3-year term. The initial members have staggered terms, 3 for 3 years, 2 members for 2 years, 2 members for 1 year. They are eligible for reappointment. The terms commence on March 1st. An appointed voting member may be removed for malfeasance or misconduct in office. And if a position becomes vacant, the board must appoint a member to fill that term within 60 days. On page 14, line 5, the advisory committee must select a chairman from among its members, must hold at least 4 regularly scheduled meetings each year. Special meetings may be called by the committee, and all matters are decided by a majority vote of a quorum of the voting members. Page 14, line 15, each member of the board would appoint 1 member to the advisory committee. If the number of board members exceeds 7, then the board selects all of the investment advisory committee members by majority vote. If the board consists of less than 7, then each member would appoint 1 member to the investment advisory committee, and the remaining members would be appointed by a majority vote of the board. Page 15, line 7, provides that no person can be appointed to the investment advisory committee unless that person has all the following qualifications. And these are similar to the previous draft and in this draft for the board members. So at least 10 years of investment experience, managing a portfolio in excess of $110 million, a broad understanding of financial markets, no felony conviction or disciplinary action, and no conflict of interest. Page 16, line 5 provides the duties for the Investment Advisory Committee. So they must develop, recommend, and review investment policies and procedures for the pool and recommend modifications as the committee deems appropriate to maximize total net returns while protecting principal and striving for the highest possible risk-adjusted total net return. Page 16, line 16, the committee must consult with the board as required and as requested regarding investment policies, and then report to this committee at least once per year on the pool's investment policies, procedures, authority, and execution. Finally, page 17 provides that the liability of the investment advisory committee members is governed by 123-107, and that section is reproduced in a staff comment. This would be effective July 1, 2025. With that, Mr. Chairman, happy to answer questions.
Questions on LSO 126? Committee? Seeing no questions or comments, we will go back to 125, and I think we'll start there, and we'll start with public comment. But if you want to make your public comment towards both bills, you're welcome to. Just be very clear so that we don't get confused, because we are easily confused. So public comment, who would like to share their thoughts on either of these or any of these? Anyone? Patrick, Treasurer's Office, please share your thoughts. And again, this is on both of them, one of them. Just let us know, be very clear which one you're speaking to so we know where to make notes.
Good morning, Mr. Chairman, committee. Both Patrick and Bill will be speaking to the bill.
Get a little closer to the mic, Dawn, so that the online folks can hear you. Thanks.
Thank you, Mr. Chairman. Both of my colleagues will be speaking to the bills in general terms, but I wanted to talk to you just specifically. Mine are much more direct comments. Brian mentioned that the Meyer rule is present as an option in both of these bills, and my recommendation to you would be to remove that. That is frankly improper accounting to withhold your losses until you have gains. The rest of us, we just have to suck it up when we have a loss, and that's what the accounting principles say. Generally accepted accounting principles, or GAAP, that is the policy of accounting, is that you just recognize your losses when they occur. I wouldn't put that on. That is something that the state has done, and that we receive an audit finding in the event that our losses do exceed any gains. I wouldn't recommend that you put that on the locals. My second comment has to do with the provision in 126 to pay salaries to the advisory members. Our investment funds committee does not receive a salary, and I believe that that would potentially create conflict and set a potentially bad precedent. So thank you for the time, and I'll hand it over
Ms.
to my
Williams,
colleagues.
your IFC members, they receive per diem and that's it, is that correct?
Mr. Chairman, that's
So we
right.
could match it accurately in that regard if we just said per diem but no pay.
That's correct, Mr. Chairman, thank you.
Next.
Mr. Chairman, members of the committee, Bill Pilger, General Counsel, State Treasurer's Office. Again, as Deputy Williams indicated, I've got some general comments, I guess, and they relate to both bills. Generally speaking, wanted to draw your attention to Wyoming Statute 94831, and I simply do that hopefully to remind us all that this statute also exists, investment of public funds, relates to both investments of the state treasurer, but as well as treasurers of any political subdivisions, municipalities, special districts, and so on. But part of that statute includes some, I'll say, requirements or practices that we believe would be important to include in either one of these bills. For example, 831B requires that no investment of public funds shall be made by any of the officials until the affected fiscal board of the state of Wyoming or the Board of County Commissioners, Municipal Council, and so on has authorized it. So again, requiring some sort of authorization from City Council, County Commissioners, and so on. So that authority exists. Another one in 831H requires that every political subdivision have on file a statement of investment policy. They may already have them on file since 94831 gives them authority to invest in numerous other methods of investment, but neither of these bills particularly reference any sort of inclusion in a statement of investment policy or an IPS. And as we heard earlier this morning, the IPS is obviously important for. But part of this provision in H also requires that before any person affects any investment transaction on behalf of a political subdivision or offers any investment advice to the governing body of the political subdivision, that they sign a statement indicating that he has read the policy, agrees to abide by the applicable state law with respect to the advice given and the transaction he undertakes on their behalf. So again, another protection for the political subdivisions and those that they may be working with for these investments. And then 94831M also has some language that seems that it would be prudent to include, but any local government entities, including treasurers of any political subdivisions, municipalities and so forth, that invest public funds under subsection A or needs to exercise the judgment and care of a prudent investor as specified by the Wyoming Uniform Prudent Investor Act. And then separately also requires if a local government entity contracts with another person to aid in the investment of public funds, require that the person submit to the jurisdiction of the courts of the state of Wyoming, and also act as a fiduciary with respect to those investments. And so again, just kind of best practices and obviously protection, for the local governments that would participate in either of these equity investments.
Very good. Representative Obermuller, I see you have your hand up.
Yes, thank you, Mr. Chairman. Going back to Don's suggestion that the Meyer rule not apply in this situation, just wanted her to have her clarify how it would work then without the Meyer rule. If there are capital losses, does that mean that interest and dividends would be offsetting those losses so that they would not be distributed? I mean, that's kind of my understanding of why we have the Meyer rule, is to allow some revenue to continue to flow through, even if there's a capital loss.
Ms. Williams?
Mr. Chairman, thank you, Representative Obermuller. You're exactly correct. However, it is a violation of GAAP, of generally accepted accounting principles, and as a result, we do find ourselves in the position of receiving an audit finding in the event that our losses do exceed our gains. That's just simply not a good accounting policy.
Representative Obermuller, did that answer your question?
Yes, it did. Thank you, Mr. Chairman.
Very good. Further questions? Okay. Mr. Fleming.
Thank you, Mr. Chairman. The point that I would like to make is on both of these bills, the number one factor that all of us are looking at is trying to protect the local entities. And that is something that we've done in the past and want to continue to do. Our consultant and many people have commented the one area that they see any type of malfeasance or issues in the investing arena is with local governments. The smallest of the investors are easy prey. And, whether they promise them or take them out to dinners or Super Bowl, whatever, it's prevalent across the United States and has not been addressed. So there's many people that are looking at it. So the one thing that we try to do is really protect the people who do not have the investment experience to do that. One of the things that I do want to comment on is you have all of these different rules and everything else, but the one, in my opinion, the single most important factor of this is what assets they can invest in. And so one of the biggest parts of what we do is you need a broadly diversified index. You need to have it for typically an investment cycle because you don't want to be trading in and out. And also you want to control expenses. So if you look at it, the S&P 500 index is the most widely used US broad large cap index available. So in that, we'd highly recommend that you look at something like that, or at least the SLIB would do. So to take a step back, the local governments wanted to invest in fixed income securities. So we did this before, and within the statute, there's, or in the IPS, in local government investing, which is, 12.1B, in both 6 and 7, it highlights some of the things that they can and cannot do, what they can invest in, et cetera. So on piggybacking on Bill's comments, to make sure that the rulemaking, which the SLIB with IFC does a significant amount of work to have some type of rules that you would put into place. So one of the biggest things are in our internal funds, the funds that we invest, we do not invest with S&P 500 managers. 85% over a 10-year period of S&P managers do not beat the index. And then when you look at how many actually are in the top quartile for 3 years in a row, it's less than 1%. So the way we look at it is saying, we have a lot of things going on. We're going to focus on the areas where we can really produce alpha, and we just index the funds. So here you have local government investors who have, I would say, less experience that are going to pick stocks. This is where you get, these salespeople who put annuities out there. They get 6 to 7% commissions on them. You put them into these pink sheets, penny stocks. This is where you get into a problem. So one of the things that I would like to highlight is with an S&P 500 index fund, a Vanguard fund charges 3 basis points. The largest fund is BlackRock's SPDR, SPY. It charges 9.5 basis points. So the same thing that we did in the fixed income side, which is very, very risk averse. And here we're talking about the most risky investment. To focus on what you're doing would be, I think, extremely, what you can invest in would be paramount to any of these other things. So if you put on, I'll just throw out 20 basis points. We did the same thing with the fixed income. We said 50 basis points. The SLIB did. So you could do that. You cannot have loads, front loaded or back loaded. That's a sales commission as well. And the one thing that we miss that some people have been supposedly taken advantage of is they don't call it a load, they call it a sales commission. So any of you can go on to any of these fund sites right now and transact at 0 commission. So I'm not saying it's 0, but if it's extremely low, all of this nefarious dealing out there will go away because they're like, well, we're not gonna do this for $100 or whatever unless we can rip them off for thousands. We're not going to do it. And the compounding of not paying those fees is wonderful. We've talked about compounding. So if you're not paying a 1% fee or whatever, all of that is compounding over these years. So it just makes all the sense in the world to have some type of limitation on what they're able to invest in. And then on the flip side, on the first bill, do you really need a investment committee to dictate what index, S&P 500 index fund you're going to invest in? Anyone could do it. So it really simplifies the process that if all you're able to do is an S&P 500 fund, many of these things will go by the wayside. So if you have 10 million or 15 million, whatever the number is, there is no way that you could get a broadly diversified index with that amount of money. That's why these ETFs are wonderful for the average investor because you just get a piece of, Warren Buffett's, Berkshire Hathaway, what is it? I don't even know now, 680,800, it's some ridiculous amount. So how are you going to replicate that with the type of funds? So all of these things, just make all the sense in the world for these local governments to only be able to invest in an S&P 500 fund and only do it through an index amount, low expense ratio, and 0 or negligible commissions, no loads, et cetera, that are spelled out in the SLIB. If you want to just look at section 12 in the IPS, the SLIB has set standards for what they can and cannot do. So to me, that is the single most important thing. Otherwise, you're opening up a can of worms. Thank you.
Here. Thank you. Questions for Mr. Fleming? Senator Hicks.
Mr. Chairman, thank you, and thank you, Patrick. And I'm going to direct this to the treasurer's office, and the treasurer may want to answer this question too. But the very purpose of these bills, based on that constitutional amendment that was passed, was just to allow local governments to invest in equities. And that's really what we're trying to do, is set this up. And I know we've had some discussion, but if you would refresh my memory, are we not trying to do that with the new WIO-Star 3 that effectuates exactly what this would do, is to allow local governments to invest in equities through the treasurer's office by buying into that fund?
Mr. Chairman, Senator, absolutely. We're in the process of doing WIO-Star 3 right now. And what is the investment that they will be eligible to invest in? An S&P 500 index fund. That's it. We're going to go out, and each entity that would join with us, they can invest in a separate account. So there's no question of whatever, they want to have or what have you. You'll have a separate account with your own amount of investments. You know every single day how many shares you own. You could look at it and calculate your P&L every single day if you want. There's no waiting for the end of the month or what have you. But there are many local investors that, talked about, it's like, oh, well, we don't want to be beholden like WIO-Star 2, which I've testified that they've lost a significant amount of money by leaving WIO-Star 2 because our fund was up 6.6% and they're only getting 3-month T-bills. So, but if they want to, they can invest on their own.
So, Mr. Chairman, if I may, so Patrick, in your opinion, the risk that you outlined as far as asset allocation cycles, controlling expenses, all that stuff, that now basically falls on the treasurer's office and the investment team to assume all of those responsibilities versus having either a local investment advisor. So we're inherently accepting and understand and mitigating all those circumstances through WIO-Star through associated with investment in equities. Is that correct?
Mr. Chairman, Senator, absolutely. We do not charge commissions. We do not charge management fees. It's, if that's what you're going to do. Now, we do have, we're going through the rule making right now. We don't have it set in stone, but all of the things that I referred to, you want to be making sure that these individuals are not day trading. So you have limited amount of time, or a time limit of your investment period. The typical business cycle is 7 years. But if you say, okay, that's a long period, what about 5? But you'll be able to spend dividends. There's all the different rules that we're making, but it would be, well, just by definition alone, you will have a better return unless, I can't think of, unless Vanguard goes under, or, BlackRock, multi-billion, how many trillion does BlackRock manage, goes under, you're better off with WIO-Star 3 just because there's no fees. There's nothing that they could do in an index fund that would be lower commission and funds than what we're doing.
So, Mr. Chairman, I just wish you wouldn't refer to some of those companies that they're going to go under, because I got a lot of retirement investments in there. You're making me nervous now, but anyway.
Yeah, Mr. Chairman.
Mr. Chairman, the reason I bring that point up is there is another alternative out there to these two bills. And I just think as we get into this discussion, we need to have the discussion about, in the context of all three alternatives, not just these two alternatives. And that's the reason that I brought that up. Thank you, Mr. Chairman.
Thank you, Senator Hicks. Great point.
Yeah, Mr. Chairman.
Treasurer Meyer.
I'd like to have Bill kind of give you the 30,000 foot, of the rules where they are right now, because they're primarily for the larger, folks out there that have quite a little bit of money. I think where these bills are trying to reach is trying to get everybody to be able to get in the stock market. But Bill, can you kind of give the parameters on that? Then I've got a couple of comments on these bills after that.
Go ahead.
Mr. Chair, members of the committee, very, very high level, obviously, as Patrick and the treasurer have indicated, we're in the middle of the rules process. But because these are investment in equities, we're looking at long duration, as I believe a 5-year minimum hold. And I think we're also looking at a minimum of 5 million investment. So don't quote me on those. That, like I said, they're a work in progress, but we're in that in the rules process right now, trying to solidify that, working and pursuing, contracts with potential managers for that, whether it's Vanguard or others.
Mr. Fleming? Based on the rule comment that was just made at 5 million, would there be like an opportunity for a subset of WildStar 3 for smaller entities that didn't have that kind of money available to still be able to do something?
I think what we'd have to do is find out what Interactive Brokers is going to be able to do to set us up on each individual fund, because there'll be a charge for that. And I'm not sure what that would be. Do we have any idea what those per separately managed account at Interactive Brokers is going to be?
I believe they're about $65 a month to set them up per month that we do not pass on. But the big part of that is the reason that we came up with 5 is just, if you look at a typical 60-40, everyone talks about 60-40. So what are you saying, like 12 million in assets? If you really have less than, let's just say 10 million, and you're not able to put forth an illiquid part of 5 million or what have you, should you really be invested in equities? And so the reason that we're putting this threshold in there is to make it for funds that should only be invested in equities. If you're really that small of an entity and you don't have the income coming through, just like many of institutions and so forth that go out there, ourselves included, where we only had bonds at one point, you really have to question whether equities are the best investment for somebody that has that small of an asset base and not being able to invest throughout a business cycle. And so that's why we're putting it. But, having this for someone, having this bill or setting this up for someone who does want to do that and wants to take the risk, we don't want to say, no, you could do whatever you want. In the pooled investment in the bills, you could pool a bunch of different people and they could do it for smaller amounts. So we're not saying that it's a bad bill and you shouldn't do this. All we're saying is that the parameters for what they can invest in needs to be extremely tight, because this is an area that many people get taken advantage of.
Very good. Thank you.
I'd guess that if you were going to expand those, the way the bill is now is that essentially they could invest in anything. And ETFs, index funds, I think are most likely the best way to do it. I don't know if any of you guys are familiar with the 457 plan. There's certain classes there. You can do small, mid, international, large cap, real assets, and bonds. Now, bonds really don't enter into this because these guys have already got their setup on their bonds. But so that would be, I think, the maximum that would you do. I think that you still leave the overall arching rules perhaps at the SLIB board level to cap the fees, so that you're not getting some people that are actually charging a lot more on Main Street than what should be charged. And I think that's an area of oversight. Looking at the structure there too, I know there was some discussion in one of the bills that make it kind of like our selection committee for the IFC. Well, there's not a third-party handoff, because you've got the Joint Powers Board actually selecting the advisory members. So if you wanted a third-party handoff like we do with our selection committee, I did get a hold of the chairman of the selection committee to give us some feedback, and I did call one of the members that I appointed, and he thought that, I asked him the question, do you need 2 selection committees or 1 selection committee? From his perspective, he'd be willing to serve on a single selection committee, so, and I guess what you do have there is that you do have a pool of people that that wanted to do public service and advise and do selections, and they've got a good pool of people that could be on a advisory committee. And then you don't have the Joint Powers Board essentially, I guess, hiring people as advisors that necessarily aren't necessarily as qualified as what's out there in the universe, because there's a lot of people in Wyoming that want to do their civic duty that know what's going on. So there's just a few things there, but I agree wholeheartedly with Patrick that yeah, it has to be an index fund. Vanguard, from my perspective, if you're ESG conscious, they're the best fund out there from our Wyoming values. They're the top. I think actually BlackRock, I think, is next, and then you've got State Street, which is the worst. I'm not sure where Fidelity is, but so that's you know, some of the things that I think that we're looking at is we don't need to put in, I think, in our operation another 150 separately managed funds that we're going to get phone calls on, you know, every day about doing one thing or another thing, because it takes us 2 employees to run our WildStar 1 and 2 now. And we're looking at some software that'll probably help somewhat, but if we did all of this in-house, I'm sure the deputy could probably come up with the number of people that would probably, I guess, add to that workload. And so I'm perfectly willing to say, let Main Street in Wyoming have a piece of this. But if we do it, you guys put enough sideboards on there so these guys, you know, necessarily understand why they're doing it. And there's all kinds of use cases in different communities where you know, they've got some long-term sinking funds, or they got some funds for different areas, whether it's you know, sewer funds or hospital funds or whatever. They've got some areas where they could have some more than 5 years. But then a lot of folks, from what I understood at the county treasurer's office, the offices up there in Rock Springs, is that a lot of people, you know, they want to be in it, but they really don't have a lot of background. But I guess if I look at the 457 plan, if we can offer that to our state employees, then something that was akin to that has the low index fees but a very limited menu that would offer some options might make sense, but they still need an advisory committee to kind of help them. They ask me, well, can you do our portfolio recommendations in construction as a treasurer's office? Now that is something I think beyond that I think the folks on Main Street could probably do just as good a job in some ways that we could, if you basically tie their hands a bit and make sure that these guys don't get overcharged, and they don't have a huge you know, I guess, concentrated risk in a few stocks. So I think we're probably pretty much on the same page there. I'm a little bit more liberal, I would guess, than just the S&P 500, but the whole thing is that have a list of ETFs in the bill that's permissible. You know, I call it a white list because that reminds me of what you do with computer access into programs. But essentially, it's permissible activities, and that will get people started. And I don't think they'll run into a lot of problems. They're still going to have problems with you know, basically selling low and buying high. You know, they will. There's no doubt about it. And yeah, they're going to do it. There's no doubt in my mind that you're going to see that. And that's one of the things that particular, I guess, risk that if we're involved with folks that don't have that background and they don't have an advisory system that's functional, then you know, essentially, we'd rather have somebody else have that, I'd say, almost headline risk, because that's something that I think you can protect them all you can, and I think you can do it in this bill, but there's gonna be some people that are gonna have buyer's remorse. That's the stock market.
Mr. Chairman?
Senator Hicks.
So one of the things, and I'm just trying to think about back with our asset allocation and some of the discussions we have of what constitutes an equity nowadays. And so it seems like there's a much broader definition, or at least from the way we invest money with the treasurer's offices, as to what constitutes an equity, whether or MLPs and
Anything but
private
fixed
equity and private credit and all these things. And so one of my concerns with this is, if we move these forward, do we really need to really specify what we mean by equities? Because it's an ever broadening term within the investment horizon. And my concern is the latest and greatest new category that may arise out there could potentially be listed under that area. So
Yeah, I think it's anything but fixed income, but if you put in a permissible list of investments, and that's all they can invest in, and it's all only ETF indexed funds, and you can put a little bit of diversity in there if you use the categories that are in the 457 plan. But that would keep you away from doing private equities. That would keep you away from them saying, gee, Bob's got a great idea down here that we can build in our investment park. Let's put all our money in that basket. What do you say, boys? You know, that'll keep them away from those type of things, you know.
Thank you. Further questions for the Treasurer's Office team? Senator Furphy.
Thank you, Mr. Chairman. Help me to understand this. If we invest in the S&P 500, and if we go with one of the national index funds, so there's a lot of money in there, then we don't care if someone pulls out. They don't have to keep it in for 5 years, because it's so diversified across the country in these big index funds. My only question is, if we do that, is that an accounting nightmare for you guys, with funds coming in at different times, et cetera? So they need, when they pull out too early, they need to absorb the loss, or we need to give them the gain from when they put in. Does all that make sense? Thank you, Mr. Chairman.
Yeah, I think we're doing separately managed funds, so it's their fund. They're not with anybody else if it's an individual. Now, if it's in the pooled investment thing, then I think that accounting probably would go back to the local subdivisions about, you know, how much is going in from which individual or political subdivision. But yeah, as a nightmare, if we had to keep track of the pools, I mean, we've got you know, 70 managers and 15 pools, you know, or funds. And so if we've got, you know, political subdivisions, and say there's 120 in there, then, you know, where do you want us to spend our time accounting? We'd probably have to have, you know, maybe another 30 accountants, you know. But the people on Main Street, you know, they're part of a I guess a qualified accounting firm that, you know, whether it's Schwab or Wells Fargo or anybody else, they've got that back room to where they can handle individual funds. Where if we were asked to be basically do the same work as somebody on Main Street on individual funds, yeah, that would be an accounting software problem or problem. I think we'd rather not get into day, you know, as Patrick was saying, day trading and on that, pulling in and out of it. But to your point, exactly, yeah, it makes no difference on the index, you know, because we can't really affect that. Our political subdivisions won't have enough money to affect that, but it just affects their own fund.
Mr. Chairman.
Senator Furphy, follow up, excuse me.
Thank you. Well, that's my problem with both of these bills. They don't specify what's going to be invested in equities. And I have a real problem with that. The first one, only one person makes the decision what equities the government's going to vote in. On the second one, you've got this investment committee, and my point being, really, if we invest in a national index fund, you don't need all these people. You just invest in it and pull out. So that's where I'm coming from, Mr. Chairman. Thank you.
Thank you, Senator Furphy. Thank you, Treasurer's Office team. Stay close as we may have more questions as we work on these bills.
The
Further
index
public.
fund, the index fund simplifies it and eliminates a lot of the risk.
Further public comment?
So long as you don't start working anything.
Proceed.
Okay.
Introduce
Mr.
yourself.
Chairman, members of the committee, my name is Ashley Harpstreet. I'm the Executive Director for Wyoming Association of Municipalities. WAM is a 501c6 private nonprofit association that provides educational resources to our 99 municipalities. Since 1967, WAM's mission is to advocate for cities and towns' common interests, and that WAM supports policy that allows local decision-making closest to the 68% of the people that live within the borders. Mr. Chairman, I can tell you our membership supports both of these concepts. Last meeting, there was a request to provide feedback on the interest of this type of legislation and tool for locals, and I sent you all via email their responses this week. I can tell you, Mr. Chairman, since the passage of this constitutional amendment and now the continued discussion of this concept, membership awareness and interest is broadening. The main point is municipalities would like the ability to leverage diversified revenue streams like the state does for 30% of their revenues and keep service costs low to their residents. We hope this opportunity will create a safe and competitive environment that will yield the best results for our communities looking to maximize their returns. Knowing that this committee is partial to 126, we are supportive of the proposed amendments from Wyoming County Commissioners Association. I have a few members who are engaged and will be on later to testify. With that, WAM stands in support and ready to educate our cities on towns on the mechanics of this implementation. Thank you.
Thank you. Jeremiah?
Good morning. I think we're still morning. Members of the committee, I'm Jeremiah Riemann here on behalf of the County Commissioners Association. I want to express my deep appreciation that you're having this conversation about both of these bills. I'll just start off by saying nobody stands to lose more than our two associations if something goes wrong in this scenario. We're very aware of the issues that can arise and have heard you. And I want to just state that none of us support day trading, penny stocks, unregistered investments that any other person might be able to get into. We want to make sure that we approach this with the soundest of mind. Mr. Chairman, I know that as Ms. Harpstreet has indicated, there's a preference for 126, and we certainly are fine with that. I'll get into that particular legislation a little bit more here briefly. Senator Hicks had in particular asked for us to go back and poll our members. I know Ashley has shared some of the data relative to the municipalities. I would say under previous iterations of either of these concepts, it was a very small subset of counties that might have the wherewithal to pursue this. But I think some of the important changes that you've made, more counties are interested in at least looking at the option. That's not to say that every one of them is going to invest, but I asked our members at our most recent Association of County Officers meeting how many of them would look, and every single county that was there, I think we had just short of the 23, all of them said they would at least take a look. It's not, again, not to say that they would invest, but they would take a look. Mr. Chairman, going to 126, this Joint Powers Board concept came forward in hearing your concerns about the potential for the day trading, the penny stocks, the other things that can come up. We're trying to find a way where we could bind organizations, counties, and municipalities together so that we're doing this most appropriately. I want to point out just a couple things relative to joint powers boards. Of course, that requires more than one entity to come together, more than one governmental body. And you can look at the joint powers statutes in Title 16, 1. I want to just bring one particular part of that up to you, and that is that any joint powers agreement that's put together has to go to the Attorney General's office. And the specific language in statute at 16.1.105A2 says that it shall be submitted to and approved by the Wyoming Attorney General, who shall determine whether the agreement or amendment is in compliance with the laws and the Constitution of the state of Wyoming. That's important. It is another check in all of this. If you all are concerned enough that we're not going to put together a safe approach here, by all means, I'm happy to have our joint powers board, assuming one is put together, be checked by the state treasurer's office or perhaps others, maybe this board. But I do ask that you continue to actively look at it. While Star 3 is certainly an option, we're deeply appreciative that you passed that legislation last year. My members are simply asking for a second option that is in some ways closer to the local governments because they would be actively participating under 126. They are looking for something that is available more broadly. And third, in sitting down with the state treasurer, we've heard his concerns about capacity and the number of local governments that might come forward. And so we see this as a viable option and appreciate his support. Mr. Chairman, I did submit some amendments to you. I'll just go through them briefly and hope that we might be able to address some of the things that we've heard. I'll start on page 5, lines 14 through 16, simply asking that you delete the language that shows up there and simply leave it that we can establish assessments and fees for the participating local governments. I actually read this language that's on lines 14 through 16 to just say these are ways that you can assess, but some have read that as those are the only ways that we can assess. So I think the easiest thing is just to delete that language. Mr. Chairman, moving over to page 6, and I'm looking at lines 14 through 20. The term there is person. If you look at the state treasurer's statutes, you use a person or that person's firm. And I know that you had talked about maybe broadening that at your last meeting, so I just bring that forward as a potential amendment. I would also just, and I've included it in the document that I've provided to you, just indicate that in state treasurer statutes, it does have that the firm has to have at least, or the individual person or person's firm has to have 5 years of investment experience. Here you have 10. Just a question, we're fine either way, but maybe some consistency could be there. You do have a $110 million portfolio. For this draft 126, the state treasurer's office is $1 billion. Maybe there's some sense in bringing it up. I don't know that we need to go to $1 billion, but that is a possibility. Mr. Chairman, moving to page 10, line 1, you do have that that there could be penalties associated with early withdrawal, and that's absolutely appropriate, but there could be other times where it's a non-early withdrawal that could incur expenses for the pool, and it might be appropriate for us to have that authority, so just recommending that you delete early. Mr. Chairman, moving down to the 30%, again, I'm appreciative that you actually put this provision in over the provisions that were previously there, but would just note that perhaps we need to include a provision at the end of line 22 that indicates that that's 30% at the time of investment. There are some that are concerned that if that's a day-to-day assessment, it may force the early withdrawal of funds. If a county, for example, had to pull out some of its reserves, its non-equity reserves for a particular issue to address, that it would force them below that 30%. So just putting in at the time of investment would be helpful. I also put a little bit of a note there at the bottom. One of Natrona County's interest is to invest the entirety of the unexpected revenues that they got from the sale of their hospital into equities, and this particular provision would prevent them from putting in a considerable amount of that. So just throwing out whether there might be a possibility for for unanticipated revenues to go into this, and we could certainly tighten that language up some. Mr. Chairman, page 11, line 15, the provisions here in terms of denying a particular local government from participating are pretty specific, so I'm trying to just suggest that there might be a catch-all provision that could go there. And then finally, Mr. Chairman, on page 15, lines 11 through 14, I've included the language from the State Treasurer's Investment Advisory Committee. Obviously, there is some discrepancy, but another point that actually came up in our conversation with the State Treasurer is that there may be some really good and important people that have executive level, CEO level experience, but aren't necessarily involved in the day-to-day investment portfolio, that we could benefit from their experience, but they would be otherwise excluded from this. So I'm just suggesting maybe we could say that the majority of the members have this sort of level of investment experience, but we could still benefit from other national, multinational individuals that could lend us some expertise. With that, Mr. Chairman, I know I've taken a bit of time here, but I do want to express that whatever, if we can get this across the finish line, and we'd really appreciate your support in doing that, it is our commitment to make sure that this is a successful program, a safe program, and of course, it meets the same standards that you've established within the State Treasurer's Office for the investment of state funds. And with that, Mr. Chairman, I'd stand for any questions.
Questions for either WHAM or county commissioners? Jeremiah or Ashley? Questions? Okay. Don't go too far, as we may have questions as the day goes on. Further public comment? Representative Knapp, we swap out public comment. Go ahead and ask your question, Representative Knapp.
My question was to both WHAM and the
Okay.
commissioners. Can you hear me okay?
Yep.
Okay. Because we've just started the parameters of Wildstar 3, which I do feel it's important to have the minimum 5-year, 5 million rules on there. Would you say that a lot of those that would participate in Wildstar 3 would switch and go to these two bills? Judging by the survey that WHAM put out, I would guess that. And can you speak to, in a downturn, the liquidity of smaller cities and towns in needing those dollars that they may have put away into a short sale?
Either one of you?
Mr. Chairman, Representative Knapp, those are great questions, and I would say at this point it's pretty speculative. Our communities are waiting to see what the parameters are around what you're going to build in the 125 and 120 or 126. If they would be pulling out of WyoStar 3 to go to something like that. I would say right now, back to my opening statement, and where Jeremiah is too, we like to have things closest to the people and local decision making. So I would assume the preference would be something they'd be more in control and closer to. We are going to have a city finance person speak here in a second that probably could answer that a little bit more carefully, as she's very intimate with what that would look like.
Yeah, thanks, Mr. Chairman and Representative Knapp. It's a great question. I think the better question is how many counties are actually going to enter into WyoStar 3? And I think at least the reality of what I'm hearing from my members is that very few of them are going to consider that option at this point in time. I think it's a variety of factors. Some within and outside, and some others outside of the control of the state treasurer's office. But right now, what I'm hearing is that most of them will not consider even entering that program.
Okay. Thank you. All right. Public comment continues. Please come forward. Thank you for stepping back up with those answers. Jeremiah and Ashley, thank you. Good morning. It's still morning. Yes, ma'am.
Good morning, Chairman and members of the committee. My name is Jill Johnson. I am the treasurer for the city of Casper, and I am here to talk about 125 and 126. So the city is supportive of both of these bills. In addition to the WyoStar 3, we believe that there have to be many options. All of our cities and towns and counties across the state of Wyoming are all very diverse. We have different sizes, different resources, and to have just one of these options would not be something that is a one-size-fits-all. It won't work for everyone. So to have multiple options is the best way for cities, counties, and towns across the state to be able to take advantage of investing in equities and getting those benefits. I actually would have almost liked to follow the treasurer's office because I am very, very supportive of what they were talking about. So as we know, the voters in the state of Wyoming have said that they want local government to be able to invest in equities. I also was concerned about what are we defining as an equity? Because from my viewpoint, I don't look at all of the different things beyond an ETF or a S&P. That would be too risky for anything that I would ever invest in. So when the amendment first passed, we actually got together with our investment advisory committee and we worked on a policy statement because that would have to go into our investment policy and the council would have to approve it. So the things that we really talked about that we would look at as far as doing equity investing would be not doing individual stocks, but instead doing ETFs. So ETFs, S&P 500 ETFs, equities, ETFs. We would look at small cap, large cap, and international, and we would look at a percentage of our total portfolio being in those. We also are very conservative, so we would not invest more than the target rate of 20%, which I know I've talked to this committee before about. And then as we would rebalance our portfolio, as those stocks appreciated or those indexes appreciated, we would rebalance our portfolio back to that target rate of the 20%. So these are some of the things that we thought were very important to us as far as making sure that the monies that we are investing in equities are safe. That is one of the primary GFOA requirements of any investment, is making sure that it is safe. So we want to, again, be able to take advantage of equities, but we want to do it in a safe way. And we are very supportive of 125, and with the Treasurer's Office offering to provide a list of ETFs that they would consider being safe, that would be what we would recommend. With that, I'd be happy to answer any questions.
Questions for Ms. Johnson? Okay, I don't see any at this time, but stay close as we may have some later.
Thank you very
Thank you.
much.
I believe online we have a Mr. Cowan from Sweetwater County. Are you available, Mr. Cowan? Please proceed,
Good
Mr.
morning.
Cowan.
Okay, Mr. Chairman.
We can. Maybe get a little closer to your microphone. You're awfully quiet.
Thank you very much. I'll speak up a little bit.
There you go.
In the office today. I just wanted to speak in support of both of these bills. Was definitely in support of the bill that gave us access to WyoStar 3. I appreciate that passing this last session. And we're certainly waiting to see what those rules are to allow us to invest in equities through the Treasurer's Office. But I am in support of both of these bills. I think our county will get behind investing in equities. And I agree with what the lady just said before me, in that those guardrails need to be in place for us to be able to invest properly. One of the things that I consider or think about is that we're talking about investing in ETFs, and we're talking about the rules that allow us to invest in ETFs and the fees that it costs to invest in ETFs. And I wonder if it might be easier for the entities to be able to set up individual accounts and invest in those ETFs anyways, with just the guidelines. So maybe setting up accounts at Fidelity or Schwab or some. Those are some of the thoughts that I've had, but I appreciate the efforts here. We're 100% behind the ability to invest in equities, and that's time for questions.
Any questions for Mr. Cowan?
Yep, Mr. Chairman, if we could just have him introduce himself for the record. Thank you.
Mr. Cowan, could you introduce yourself for the record? If we got ahead of ourselves, my mistake.
I got ahead of myself. I apologize. Mark Cowan, Sweetwater County Treasurer.
Thank you. Further questions for Mr. Cowan? Okay, seeing none. Further public comment? And I don't believe there's any more online. Senator Guru, earlier in the conversation, you had your hand up. Do you still have a comment? Sorry, I missed you when it was on top of your mind. My mistake.
Oh, thank you, Mr. Chairman. No, I actually, Senator Hicks and others have asked most of the questions that I had. I as far as comment goes on these bills, I just want to say I agree, and I think that I think these bills have merit. My issue and my big overriding concern is we passed a bill last year for WyoStar 3, and we're still in the rulemaking phase of that. And I understand and really appreciate the comments of the speakers talking about wanting to have safe and compatible investment vehicles for local communities. I think we all agree, and that's why the amendment passed. That's why we did WyoStar 3. My concern is, or my question is, would it be better to allow that to get more formed and have more opportunity to see how that's working? What's its benefits? What's its drawbacks before we enter into new waters going in these directions? I want to see Main Street to be able to get involved in these investment vehicles, but I really want to tread carefully. And it's like listening to the comments from the folks in Natrona County. I understand they're dealing at one level. Well, as as they said, we've got 99 cities and towns, 23 counties, all at different levels here. And I do want to make sure while one size fits all doesn't work, I worry about making sure that everyone has the safety from top to bottom, no matter what level of competence they each have going into it, and be able to help them make sure they have all the tools that they need to be able to make the best investment decisions. That's why I'm hesitant right now to move forward with these bills. I'm gonna be real honest with you. I think they can be tweaked and I think they're good changes to be made, but I'm hesitant to move forward with these before we have a chance to flesh out the bill that we've passed already. And so that would be my comment. Thank you, Mr. Chairman.
Other comments? Senator Nethercott?
Yeah, Mr. Chairman, thank you. I would move to table both bills at this time, really to reflect the concerns that were articulated by Senator Guru, which I think are spot on, and listening very, very carefully to the cities and counties. I heard broad-based support and the continued need to have flexibility in investing. I think it's clear that the legislature supports those efforts. But the sidebars currently in place aren't sufficient. And we need to continue to work on this, and I think we should and will. So at this time, I'd move to table.
Mr. Chairman, I second that motion.
Motion been made to table and seconded. All those in favor signify by saying aye.
Aye.
All those opposed, no. Okay, that passes to table those. So we've put us ahead of schedule now. As I stated early in the morning, we will take an extended lunch. We'll be back at approximately 2:30. Or excuse me, we're not ahead of schedule. We have one more topic this morning. My mistake. We need to discuss investment manager and alternative management investments. My mistake. For Shaw. 152, 274, 275.
Mr. Chairman?
Go ahead, Mr. Shaw.
I think what I'll do is I'll give you kind of a recap of where we're at and then figure out what you want to do with regard to the two additional bills that were drafted. At the last meeting, based on the State Treasurer's Office suggestion originally from our first meeting, we drafted a bill that would allow both investment manager decisions and alternative investment approvals to go through the IFC rather than through how it is currently done through the SLIB board. That legislation was LSO 152, and we discussed that in detail and the committee asked for two changes to be made to that original bill. I'm sorry, several changes to be made. The first was that it be split up into different topics so that the investment manager decision would be a separate bill from the decision about alternative investments. Second of all, a small amendment to make sure that it was clear that under the original bill, that manager and investment decisions could be made by the IFC and could be delegated to the state treasurer. We wanted to make sure then that delegation authority could both be made, delegated, and rescinded in both of the bills. And then the final decision was to make clear that that the delegation could be only made for individual decisions on investment managers and alternative investments, rather than some sort of carte blanche authority that would allow them to make the state treasurer to make those decisions on all issues. So that's why we now have two additional bills that are in your package, and they are listed as 274 and 275. And Mr. Chairman, if you'd like, I'll just go, the two bills are simple because they really are just extensions of what we did last time. Looking first at 25 LSO 274, this is the bill that is divided up into the investment manager approval. It's virtually identical to the last bill, other than, as I said, it gives the IFC power to both delegate and rescind delegation to the state treasurer. And then it makes clear that you can only delegate individual manager decisions, not a continuing authority applicable to all managers. I would point out in the bill, I guess I would say page 2, line 17 is that additional language. It says, at the very, it says and rescind. So this investment funds committee may delegate and rescind investment manager approval authority. And then the language right below that on lines 20 through 23 is the new language that specifies that only individual manager decisions can be delegated. I've included a staff comment on page 3 that I think is important only because originally the committee asked that the bills include a provision that upon the election of a new state treasurer, all delegation authority would have to be reconsidered. That is not in this bill because now the bill says that you have to make the decision on each individual manager. So I don't think that would make much sense to have both provisions in the bill. If the committee disagrees, I did provide some language there we can use, but I don't think both provisions would be necessary. So moving on then to 275, it's really a very similar bill also to what was considered at the last meeting. This one has a couple of other just very small changes that are fairly insignificant, but I'll go over them with you. This bill, again, provides IFC approval to both delegate and rescind delegations. It provides for single alternative investment decisions.
Representative Larson.
We've got some conversation going on that's a little disruptive. Thank you.
Please proceed, Ian.
Mr. Chairman?
We're on 275 now.
Yeah, 275, that's right. And this is the bill dealing only with alternative investment approval. It provides for the single alternative investment decisions only to be delegated to the state treasurer. It includes some better conforming amendment language that I'll cover with you, but it's just kind of technicalities, nothing that substantively changes the bill. And then it provides a modified reporting requirement. The committee asked that the reporting requirement that was in the original bill be extended to both bills. And so I've done that, but it has to be kind of modified to only apply to alternative investment decisions. So on this bill, on page 2, I'll refer you to line 10, which provides that the Investment Funds Committee may delegate and rescind its authority to approve alternative investments. That's a change from the last bill. And then lines 12 through 17 on page 2 is the language that provides for single alternative investment decisions only that may be delegated to the state treasurer. Again, on this bill, I've provided a staff comment that talks about whether we need to talk about the election of a new state treasurer and have that provision, and I don't think we do because, again, this bill provides for only the delegation of single decisions, not carte blanche authority. On page 3, on the bottom of page 3, lines 28 through 31. I point this out only because it's new language from the prior bill, but it's simply a conforming amendment that makes sure, it just simply provides that the state treasurer, if the state treasurer is delegated authority to make these decisions, is under the exact same obligations that the IFC would be. It says if approval authority is delegated to the state treasurer, the approval of the state treasurer shall be complete after consideration of any recommendations from the Investment Funds Committee and upon the review of the review and written acceptance by the state treasurer of the material terms of that instrument governing the investment. That's identical language that already applies to the IFC. On page 4, again, there is a new conforming amendment on lines 17 through 19 that doesn't change the substance of the bill. It just provides that the Investment Funds Committee, or if approval authority is delegated to the state treasurer, provides the alternatives there. And then the new reporting requirement, I shouldn't say the new reporting requirement, but the reporting requirement that had to be revised is on page 4 at lines 21 through 25. Simply says the Investment Funds Committee shall report to the board not less than semi-annually regarding the approval or disapproval of any investment in alternative investments and regarding any delegation of approval authority to the state treasurer. Those are the two issues that are changed in this bill. So, Mr. Chairman, that's the difference in these two bills. That's why it's been split into two from our original bill from the prior meeting.
Mr. Chairman.
Senator Hicks.
A question, Mr. Chairman, for Ian on those. The way it's in both bills, it says the Investment Funds Committee may delegate its authority, but is that a simple majority, supermajority? How do you interpret that? Is it just a simple majority of the committee would make that recommendation?
Mr. Chairman, I think the bill tries to make clear that it actually is a majority of the entire Investment Funds Committee. And in fact, there's a conforming amendment in the bill on page 5. Well, on these other bills, it talks about that requires that a majority of the entire membership do that. And let me find that language for you here.
Yeah, it's page 5, line 14 through 16, I believe. All
So it-
matters shall be decided by a majority vote.
Right, and that's right, and it says the approve alternative to the state treasurer upon a majority vote of the investment funds committee. That would mean the entire committee, not a quorum of that committee. So that's standard language that is used in our statute, and it would require a majority of the entire committee, not just a quorum.
Very good. Questions for Mr. Shaw? Is he the presenter? Thoughts or comments? Okay. Public comment.
Well, I want to.
Treasurer Meyer.
Yeah, I want to thank you guys for your attempt to move this down the road, and I want to thank the LSO staff for their diligence work on it. But at this point in time, I just don't see either one of these things moving forward that we could support. But thank you for everything that you did. There's just some, yeah, I think, I don't think I even want to attempt to try to amend this because I'm not sure whether we can get there. But thank you for everything that you've done.
Deputy Williams?
Mr. Chairman, just to clarify, I believe the treasurer is referring to both of these new bills, 274 and 275. We like 152 the way it is. If you were to amend 152 per the governor's suggestion to remove the delegation to the treasurer, we would not be supportive of that, though. To clarify.
Okay. Questions for the treasurer's office? All
Mr.
right.
Chairman.
Senator Hicks.
So I'm still back on the investment fund committee voting by a majority. And so this is a question, because the treasurer is a member of the investment funds committee. Do we need to have, and I guess I would be curious as to your thoughts, but it seems like you're voting on delegating your own authority. And so to me, there's an apparent conflict associated with being a member of a committee that's voting now on that. So I just curious as your thoughts with that provision, particularly with the simple majority. So it's.
Treasurer Meyer?
It was unclear to me whether or not, when you said the entire committee, whether the legislative liaisons were going to be able to vote and the other folks that don't have voting. It was unclear to me whether, when you say all committee, whether or not all the ex officio members were actually voting. You know, because it doesn't say voting members, it says all members. And so that I think is a problem. There's no delegation at all in the second bill because you're only delegating it on a case-by-case basis. So essentially, you go through the process and they say, oh, well, we'll let you vote on this one because we approve it. You know, it just seems like it's just a ridiculous cat and mouse game in that one there. Really, I guess I get down to the premise that the treasurer's office is a professional office. And I look at what we've been able to do, and I really look at the advisory information that we get from our IFC members, and it's top of the line. And we go through all of this, and as we look at it, I think that with the exception of last week, I think we've always had 100% support, you know, from the IFC going to the SLIB board. And the one person that voted against it couldn't, they had a medical situation in their family, couldn't attend our presentation to the IFC board. And basically our committee vice chairman said that she had thought after talking to her that had she attended that, she would have understood and probably voted in favor of it. But I guess we look at our track record over the last several years, and a good, excellent working relationship with our IFC members. It's got, I think, a huge ex officio representation with 2 legislators and both the CIO from our CIO and WRS's CIO. It's very functional. There's a great group of experts. We've got, I guess, good back and forth with the legislative members. And from my perspective, that the consultation that we have with it and the way the process is now with RVK essentially recommending to us our selections and in the process that the team uses with our senior investment officers and that our analysts and our chief investment officer working with RVK, bringing that forward and in consultation with the IFC. I think that we've always made the right decision without the oversight of basically the SLIB board. And where we have this year, we did something I think very extraordinary just in the last week or two, where we had to have the approval of our investment real estate. We had a manager IDR that came forward with a way that really made sense to, as you heard earlier in the performance thing, we were underweight our non-core, and so it's a way to actually all the pieces fell together in this one particular deal, but we had to have it approved by November 1st. And we were able to mobilize the SLIB board and actually got it done. It was, we didn't know whether we were going to be able to do that. And if we continue working with the SLIB board, I think there are going to be times when we're going to miss out on this deal. So it would have cost us somewhere between $11 and $50 million had we not gotten that through. And this is what we're really trying to do, is make sure that we're working with the professionals. You know, from my perspective as a treasurer, and I look at the experts. And we've got a good deal of experts here in this room, but I don't think you guys would essentially say, well, we're going to let the LSO make all the decisions of the legislative process because you're elected public officials. And frankly, I'm in the same place that you guys are. I'm an elected public official. And essentially, you've got your experts, we've got our experts, you guys make your decisions, you vote on them. You know, from my perspective, that's where we should be. You know, and these bills actually got worse the farther we went through them. And I think that it's just like whether you're not going to believe in the constitutional system that we have in place and you're elected public officials to make the right decision, or whether or not you're going to defer everything to the experts and to public officials that don't necessarily have the I guess the investment training that's necessarily to really make those decisions.
Representative Larson.
Thank you. So, Mr. Treasurer and Don, and I appreciate you bringing up the legislature, because I think that's right, because there's checks and balances. The House passes a bill, it goes over to the Senate. They don't like it, they whack it or they change it. There's a process to ensure that there's just not total control from one body to the other. And then we pass it, it goes down to the governor's office, and he could veto, we override it. So there's these checks and balances. And then in the state treasurer's office, we've had the board, it's been the SLIB board that's improved these. You guys have come back to us with a valid request for some flexibility on these alternative investments. The problem, Mr. Treasurer, that I had in the Bill Draft 152 is, as I read it, it said the Investment Funds Committee could delegate its authority to approve alternative investments to you, but there's no time frame on it. That goes away from the checks and balances that you're referring to, and it was very problematic for me. But recognizing that we need that flexibility and recognizing that we need the flexibility to have you make those decisions from time to time, I think has had relevance. And so in these two drafts where we allow that flexibility for the Investment Funds Committee to approve those alternative investments, and when needed by a vote, could delegate that approval to you for that specific investment in trying to accomplish that flexibility to get those investments made. Does this not accomplish that? And then explain to me how not.
No, because you're doing it on every specific manager. And so there's no delegation whatsoever, because the IFC are always going to be in consultation. I think you should never get rid of the consultation of the managers with the IFC. But essentially what you've done is that you've said you gave it away in the first part of it, and you took it away in the second part of it by saying that on every manager, they can delegate it. Well, there's no delegation if they get together and you have the consultation and they say, oh, we're going to delegate it to you. Why don't they just vote? You don't give the treasurer any authority whatsoever in that bill. You know, and you look at the how WRS does it. You know, essentially, they understand that they've got like maybe 4 people on that board that actually know anything about investments, and they get kind of trained up a little bit. But the reason that that we delegated it to, you know, the CIO and those folks that are the professionals in WRS, and it was just like because they didn't want to have the folks that weren't investment professionals. There's about 4 of them on there, but the rest of them that were essentially representing the state employees and representing other interests that didn't have the background and experience. They knew that they couldn't do the job justice. And that gets back into the historical perspective of the state retirement.
I think you've answered that. So and thank you, because I just wasn't seeing it that way. Thank you.
Yeah.
For Senator Guru, I see you have your hand up. Senator Guru maybe bumped his hand and unintentionally has it raised. Further public comment?
I don't see. I'm missing it.
Thank you guys for everything you try to do here.
Thank you for the comments. Further public comment? Please proceed, Ms. Anderson.
Good afternoon, Mr. Chairman, members of the committee. My name is Betsy Anderson, and I'm the Deputy Chief of Staff and General Counsel for Governor Gordon. I'll try to be brief because I have testified at the last meeting regarding the governor's concerns, as the treasurer has mentioned, with the delegation of the investment management and alternative investment selection by the IFC to the treasurer. I did want to make clear that the governor does support this bill, which gives the IFC the responsibilities to select managers. And as I was listening this morning, the gentleman from RVK, I think, described it well. and that it is the obligation of the board, when they do not have the particular expertise that is needed, that they do go out and obtain that expertise, which I think the SLIB has done through the Investment Funds Committee. And you, the legislature, you set up the Investment Funds Committee, then this is the mechanism or system by which the SLIB can get the expert advice that it needs. And I think what we're asking for now is just the next step is to actually give the committee that authority to actually make the selection of the manager or the alternative investment. I know there's been comments about the retirement system and how they allow their staff to select the managers. That board has delegated that authority, but I would note that they don't have anything comparable to the IFC. And so to me, that's best, that is where it is best that that authority lie. So with regards to the bill, it's really only the delegation provision that is of concern. The governor believes that authority should stay with the IFC. I also want to reiterate that it is nothing personal. The governor's stand on this is just that the delegation of the selection of managers and alternative investments is to the state treasurer is just too much power in one person. I said before, we don't know who the next treasurer will be, much less who will sit in that position 10 or 20 years from now. The division of the bill into the prior draft into the two separate bills, I don't feel like it solves the problem. I know there were a few changes about how often the IFC has to delegate that authority, but the basic premise of delegating that authority is just something the governor doesn't support. I mean, I think he's fine with the original bill the way it was, with just removing that delegation language. So with that, I'm happy to stand for any questions.
Questions for Ms. Anderson? Okay, seeing none, thank you for your comments. Further public comment? Karen, do we have any online public comment? No public comment online. Okay. With that, we'll bring the bill back up here. And committee, what's your pleasure? On which bill? There's three. We have three bills before us, committee, and so we need to decide how we want to proceed. On 152. So I have a motion to move 152. Is there a second?
I'll second.
There's a second. Discussion. We're on LSO, 25 LSO 152. This is the original bill from last meeting. Representative Larson, and turn on your mic so our online friends can hear us. Thank you.
Thank you. So we've moved to been second. Are we going to work the bill then?
I believe that's where we are now. Again, we're on 25 LSO 152.
Mr. Chairman.
Representative Larson.
On page 2, I would like to make an amendment and on line 12, after the new period behind investments, delete the rest of that line, then on through line 16. So my intent here, well, I'll explain my intent if I get a second.
So just for clarity, could you repeat that?
So on line 12, I would, after investments, we have a new period.
Okay.
From that point on through line 16, I would delete, and there's probably some additional, and on page 20, or on same page, line 22 and 23, delete that language.
Mr. Shaw?
if you, this is just a suggestion for the committee, but if you want to present a conceptual amendment on that issue, for example, if you want to take away the delegation of the treasurer, I can easily make those
That
amendments.
that is my intent.
Okay, so state it that way then, please. Thanks, Representative Larson.
So I'd like to make a conceptual amendment that takes away that takes away the delegation to the state treasurer.
Okay. Is there a second?
Second.
There's a second. Any discussion on the proposed amendment?
Mr. Chairman, I have one question just for clarification.
Yes, Mr. Shaw.
Would that apply then to both the alternative investments and the manager selection? Because this bill deals with both.
In the alternative, yes, in both.
It's been moved and seconded. The concept of removing the delegation authority for the treasurer is the conceptual amendment here for both alternative investments and for managers, excuse me, had a brain blank there. Any further discussion? Not seeing any online. Further discussion? Hearing none. All those in favor signify by saying aye.
Aye.
All those opposed, no?
No.
Okay, we're gonna have to do a hand raise due to our split committee of online and in person. So all those in favor, please signify by saying aye. And Karen, I'm gonna ask you to monitor the online and tell me the online count, because I don't know who all's online currently. We're on aye. So all those in favor of the amendment, please raise your hand. Now, 3. So we have 3 online and 1 in person. So that's 4. Just want the committee to confirm. All those opposed now. Okay, we have a little confusion, Representative Harshman. Here in town, we have a hand up next to your name, and we took you as an aye a moment ago. So, Mr.
I am a
Representative,
no, Chairman.
you are a no, thank you. So that was 3 previously. And we are 1, 2, and we're still on no's. 3, 4, 5 no's, so that fails. Thank you for your patience as we're trying to get this figured out with the online and in-person folks all voting. So that motion fails. Further discussion on the bill.
Mr. Chairman,
Senator Hicks,
I do have an amendment in.
precise or conceptual?
It'll be a conceptual.
Thank you.
So when it says the Investment Funds Committee may delegate its authority to approve alternative investments to the state treasurer upon a majority vote of the Investment Funds Committee. And because the treasurer is a member of the Investment Funds Committee, I would like to add a conceptual that the treasurer shall recuse himself from any vote associated with delegating additional authority to himself. That's a conceptual. You understand what I'm trying to do?
Mr. Chairman, I do understand.
And because, and Mr. Chairman, it's because it's a simple majority vote. And so, and quite frankly, I think it's to protect the integrity of the state treasurer's office, that they shouldn't be voting themselves delegating authority, and I think it just protects the integrity of the whole process and the integrity of the treasurer to require that recusal.
Discussion on the proposed conceptual amendment. Representative Knapp. Representative Knapp, did you have discussion?
Okay, I'm unmuted now. That particular amendment is just on alternatives, right? Alternative investments.
For the managers.
Not managers.
Mr. Chairman, I really do think it should be on both. I just think that you shouldn't be voting on something that you're clearly going to then vote on and delegate more authority to yourself. And again, I think it just protects the integrity of both the committee and the treasurer that happens.
So just for clarification to the members, because this bill 152 involves both alternative investments and managers, my understanding from the bringer of the amendment is the recusal by the treasurer for that delegation is going to apply to both alternative investments and to the manager selection. Is that correct?
That is
Senator Hicks?
correct.
Okay, everyone on the committee understands that? Appears that way. Any further discussion? Seeing none, all those in favor signify by saying aye. Let's just raise our hands from the start, and that way it'll be easier. 1, 2, 3, 4, 6. Okay, 6. All those opposed, raise your hand. And 2. So that passes. Further amendments to 25 LSO 152.
Mr. Chairman?
Mr. Shaw.
I can ask some specific questions just based on the amendments that were made to the other two. Is it the committee's pleasure then to include the delegate and rescind language? So we made clear that they can both delegate and rescind in the separate bills.
Make the motion. Representative Larson?
Mr. Chairman, I would make an amendment that to comply with what Mr. Shaw recommended, or not recommended, but pointed out.
So the motion is for the IFC to be able to delegate, as well as the motion now is to rescind, and inserting that rescind language. Is there a second?
Never mind.
Representative Harshman seconds it. Discussion? Discussion on it. All we're doing is adding the language rescind. Seeing no further discussion, all those in favor signify by saying aye.
Aye.
All those opposed?
No.
Okay, that passes. Any further amendments,
Mr.
proposed
Chairman?
amendments? Mr. Shaw?
Another one to bring to your attention. I assume then that it's not the committee's pleasure to continue with the delegation for single investment decision and management decisions only. It's a broader delegation.
I believe that's the case.
Are we on 275 or still on 150?
We're on 152.
152. Yep, so that's fine, because as maybe Senator Hicks is pointing out, 152 does not contain that language.
Correct.
There are other conforming amendments that were made in here, for example, on LSO 275. I explained the language that makes clear that if there is delegation to the state treasurer, that they're held to the same standards. I guess I would look for the committee to give me approval to make those conforming amendments that are not substantive, that don't change the content of 152, the original bill, but that are conforming amendments that make it a stronger bill.
Yes, please. Please make the conforming amendments, and we'll do that by consensus. Unless I hear major opposition from the committee, please proceed.
Very good, Mr. Chairman, and I'll contain that to only those amendments that were described in the two new bills and nothing more, of course. Good. Let me just check real quick and make sure I got those. Mr. Chairman, I think actually, I have one question for you for the committee that I meant to raise earlier. That is just simply at the prior meeting, we did have a brief discussion about if the IFC has delegated decisions over investment decisions or under managers. LSO made clear to the committee that the IFC does have an exclusion from the Public Records and Public Meetings Act about those meetings. The committee took no action at the last meeting. I just didn't know if it intended to this meeting because it was an issue that I wanted to raise.
I believe we'd keep them excluded as is.
Mr. Chairman, that's all I had.
Further discussion on 25 LSO 152.
Question.
Question being called. Karen, I think we're ready for a roll call vote.
Thank you, Mr. Chairman. On 25 LSO 0152, as amended. Senator Driscoll.
Excused.
Senator Furphy.
Aye.
Senator Guru.
Aye.
Senator Hicks.
Aye.
Senator Steinmetz.
No.
Representative Harshman.
Aye.
Representative Knapp.
Representative Knapp?
No.
Representative Larson.
No.
Representative Storer. No. Representative Obermueller.
Excused.
Vice Chairman Nethercott.
Excused.
Chairman Walters.
No.
Mr. Chairman, you have 4 aye, 5 no, 3 excused.
Okay, that does not pass. Committee, is there any desire to work 274, 275 based on that vote?
Nope. Move to table or, no.
Seeing no desire to work the other two bills, knowing that they're just a division of the one we just did not pass, I think I'll table those and we'll move on. So with that, I think our morning work is complete. Check with my LSO friends over here and make sure I'm not speaking too soon. Okay, our morning work is complete. We'll be back at 2:30. Thank you very much.